Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman. That's Akiko Fujita. Here are three things you need to know this morning. Stocks are on the back foot as investors digest the Fed signaling maybe two more rate increases this year. The central bank did pause its 15-month-long rate hike campaign, but the dot plot told another story. The committee's rate projections made it clear it is not done tightening, as Chair Jay Powell highlighted persistent inflation and labor market strength. But he also made it clear that those dots are just forecasts. Doesn't mean it's definitely going to happen. Expectations for any cuts this year have been mostly dashed, while investor bets on a July hike now sit at around 70%. Meanwhile, retail sales coming in hotter than expected, rising 0.3% in May. Expectations were for a drop on the month. This follows a 0.4% increase recorded in April. The number adds to the debate over Fed policy and whether or not the economy is cooling down enough to halt the hiking process. The key theme to come out of this earnings season was a more selective consumer, although that's not necessarily reflected in these numbers. The data comes off the heels of this week's CPI reading, which showed headline inflation ticking down, but continued stickiness in the core figure that strips out food and energy. And it is the biggest restaurant IPO since Sweetgreen. Cava lists on the New York Stock Exchange this morning with its stock priced at the higher end of the range at $22 per share. That gives the smart casual food business a valuation of roughly $2.45 billion. Its growth has been rapid, its network of restaurants jumping to 263 from 22 back in 2016. That's partly thanks to acquisition of rival Zoe's Kitchen in 2018 for $300 million. So the question is whether it can justify this lofty valuation and comparisons with the likes of Chipotle. We'll ask CEO Brett Schulman this morning. You don't want to miss that.
So the Fed paused its 15-month-long rate hike campaign, but the dot plot tells the real story, or does it? The central bank's rate projection suggests two more increases this year as Chair Jay Powell highlighted persistent inflation and labor market strength.
The conditions that we need to see in place to get inflation down are coming into place, and that would be growth meaningfully below trend. It would be a labor market that's loosening. It would be goods pipelines getting healthier and healthier and that kind of thing. The things are in place that we need to see, but the process of that actually working on inflation is going to take some time. It will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, we're talking about a couple years out. I think, as anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate.
Joining us now is Chris Versace, Tematica Research Chief Investment Officer. Chris, good to talk to you this morning. So the one clear point that the Fed chair made is that there's no rate cuts this year. And yet there seems to be some mixed messaging in terms of those additional rate hikes that could come. What do you make of the dots?
So you have to remember that this kind of came out, I think, as Julie said, in the economic forecast. And forecasts, we know, can change depending on what the most recent data has to show. And we're going to continue to get a lot of data. We've actually been thinking that for a long time now, no rate cuts were going to be had this year. So that's not really surprising to us. I think what jumped out, though, is what the Fed did with its GDP forecast for this year, where it raised it from 0.4% to 1%. That kind of tells you the economy is holding up better than expected. So it stands to reason that their fight on inflation might go a little bit longer. But in just the video we were watching, though, it was funny to watch, though, because Powell was like, well, rate cuts will be, several years out. But if you look at their own forecast, they're going to go from 5.6% Fed funds rate to 4.6% by the end of 2024. So they are coming at some point. And I think a lot of this is kind of catching the market off guard. Right? Clearly, it did not expect the notion that there might be more rate hikes coming. But now we've got to digest this other data too. And to me, I think we'll hopefully get a little more clarity later today when a couple Fed heads, as I like to call them, make the rounds. I believe Waller and then another gentleman is actually speaking later today.
What grade would you give Jay Powell on his performance yesterday? I mean, listen, no matter what he says, like people come out of the woodwork criticizing him from both sides of the spectrum, saying, oh, well, they should be done hiking entirely, to they should have hiked yesterday and should be continuing to hike. What do you think?
So I'll start off by saying that is not a job I would want ever. But again, when you look at the data and you look at the Fed's 2% target, core CPI, yes, it ticked down to 5.3% in May, but wow, that is such a distance from 2%. You look at the core PCE price index, still a distance from 2%. So, it stands to reason there is more work to be done. And I think we're at the point now where they're going to start really fine-tuning at the edges their policy. And I think that's probably what they were really trying to communicate. Maybe we have one. Maybe we have two more. We'll be data dependent and see.
Is 2% part of the problem? Do they need to change that target?
This mythical 2%?
Yeah.
Yeah, I mean, it very well could be. What's wrong, you've heard people say this, what's wrong with 2.5%, what's wrong with 3%? There are structural changes that have unfolded in the economy that perhaps that is warranted revisiting.
This comes at a time when there's a lot of questions about whether, in fact, the Fed has a very good grasp on inflation. And I wonder when you hear...
You mean from these guys who said, oh, don't worry, it's transitory?
Exactly. I mean, we're talking going into last year, right? So, to what extent do you think the Fed's credibility is in question here? And when you think about what we heard from Jay Powell yesterday, does that point to the fact that they're a little behind the ball?
They are a little behind the ball, but I think when you look at what's unfolding in the data, I think everybody expected it to fall faster than it really has. So you have to step back and ask, what's different this time around? What's structurally different? And as we do that, you could look at what's going on in the employment market without question, whether it's minimum wage pressures, ticking higher over the last few years, or the tight labor market, what we're seeing in the housing market. You take a look at what Lennar said this morning, and they're seeing demand pick back up again. So that fight on shelter inflation might be a little longer in the tooth. And I think when you step back, it says that everything the Fed has done thus far has not cooled the economy to the extent that they thought it would. So more needs to be done.
Or maybe they can't.
Or maybe they can't.
Right? Maybe the tools that they have are not the tools to address the structural changes that you're talking about. And I don't know what the answer to this question is.
And then it becomes a question of to what extent the Fed can control this, right?
Exactly.
Which has been part of the conversation.
So if you remember the start of all of this with the supply chains coming out of the pandemic, those were a lot of supply chain issues. And the Fed was very clear, look, we have demand-driven tools. Right. That's all we can do is blunt demand. So it looks like they're going to have to do more of that. And, if you go back a couple Fed meetings, Powell was like, look, there's going to be some pain. And it's just not showing up yet.
Or at least not enough.
Correct.
Yeah. All right, Chris, you're going to stick around and we're going to continue this discussion now and take it to what's going on with retail, because it seems inflation has not fully stopped consumers from spending. Purchases at retail stores and restaurants unexpectedly rising in May, up 0.3% last month to about $686 billion. That's according to Census Bureau data. Chris Versace is still with us, Tematica Research Chief Investment Officer. And I guess this kind of shows what we're talking about. The demand is still there. One thing that really stuck out to me that is just bizarre to me in this report, right? You exclude motor vehicles and gas stations, right? You get a 0.4% increase. You know where the biggest increase came from of all the categories?
I'm going to guess food service.
It's not what you would guess, right? Food service was up 0.4%. Building materials, garden equipment, and supplies up 2.2%. Like what the what? I don't know where.
Yeah.
I don't really understand where that came from.
Well, I think some of that is seasonal in nature.
I guess so.
And if people are concerned about the housing market with the tight supply, what are you going to do? You're going to do some repair remodel. But when you compare that against what Home Depot had to say, look, where I live, did people go crazy doing projects around the house coming out of the pandemic? Yes. So I wasn't surprised with what Home Depot had to say, because you can only do so much. You can only go so far. But that number is very surprising. But I will say, though, that when I look at the retail sales numbers, I don't necessarily look at month over month, right? I always look year over year. Because when we think about how companies report, the earnings comparisons we look at, more often than not, it's year over year. And there, the headline was up 1.6% year over year. So when we talk about our inflation
and that category
conversation,
fell year over year, I should mention.
Yeah. And when we talk about retail sales versus inflation, wow, people are paying more for less, right? And then you strip out everything else and you look at the pure retail number, only up 0.7% year over year. So again, people are paying more, getting less.
So it is about the higher prices. But the thing that I also, it feels like there is still kind of this divide between where sentiment is versus where the spending is actually happening.
More selective, yeah.
How do we look at that divide?
You really got to, as an investor, you really got to pick your spots, right? So like when we pour over the data, like department store sales down 3.5%, right, year over year. So we know that people may not be either shopping there or that they may not be buying clothing. And that kind of fits with the narrative that we've had, that people are eating out, people are traveling. You look at the TSA data, people are traveling with, going gangbusters. United just came out recently and kind of attested to that. And you look at food service, up 8% year over year, still strong. So people are choosing and being selective where they spend, but then you flip it around, and when you have a company like Kroger that comes out and said, oh, we're seeing a lot of our higher end shoppers going towards store brands. Again, more signs of being selective.
It's about trade downs in the everyday purchases, but not necessarily in the big purchases.
Buying what I want and saving where I can.
So take that then, put this together between the Fed discussion and the retail sales discussion, and tell us what it means for my money and what, and what people should be buying right now.
So kind of the way we look at it, right? Most consumers, like you were saying, are being more selective. Where are they going to shop so they can stretch their dollars? That's going to be your Kroger's, your Walmart's, your Costco's. And I've liked Costco for quite some time, in part because it has a very differentiated business model, right? It's membership driven. And they derive, unlike Walmart or some other retailers out there, a disproportionate amount of their income from membership revenue. And they're continuing to grow their warehouse footprint, right? That means, more members, more membership income. So that's one that I absolutely like.
Any other names here? I mean, it feels like it has been consistently about the value play. If we're talking about sort of those everyday items, Costco is one. We heard that from the other big name retailers like a Walmart as well as a Target. I mean, how do you feel about some of those names in light of elevated prices?
So Walmart, absolutely. I mean, to me, one of the things that stands apart with Walmart is it's actually the largest grocery chain in the U.S., right? So people are coming in more frequently, so they can kind of, lean into that. The Walmart, in terms of taking advantage of their everyday low pricing. Target, I think, has a tougher chance. To me, Target's kind of like lost in the middle a little bit, right? Because you've got your dollar stores, right? And you've got your Costco's, BJ's, and the like, and then Target's kind of over here, so it's not, I think they're going to have a tougher time.
I want to ask about another area of the market, not retail, but sort of related to these bigger themes we're talking about, and that's technology, because that is the area that has done so consistently well, the large cap technology. If we're looking at a Fed that may be raising once, maybe twice again by year end in the face of this strong consumer spending, among other factors, what does that imply for tech stocks?
So I think we've got to step back a second, right? And I'm sure you guys have talked about this, but it bears repeating. When you look at how the technology market has exploded this year, really outperforming for the Nasdaq, it's only a handful of stocks that are really doing it, right? And it's really driven by AI-related headlines. So whether it's Microsoft, Google, to some extent Apple, Amazon, or NVIDIA, of course, all AI. And every day we continue to hear more news about AI. Even this morning, Google announcing some AI tool that allows people to virtually try on clothing. Right? Kind of interesting, but just the notion that we're continuing to see more of this. But I think your point is well taken about higher rates, because technology stocks typically, they're categorized, particularly small, medium-sized ones, borrowing. So their incremental cost goes higher, right, to do that. So the questions become, okay, now what am I going to pay for this valuation? But at the same time, too, just skirting back to the consumer, we've, $1 trillion in credit card debt, with rates, according to the New York Fed, that are the APR rates that are the highest they've ever seen since '94. And they're going to go higher. That's another headwind for the consumer, too.
Are you buying into the AI boom?
Indirectly. So in the Action Alerts Plus portfolio that I manage for the street, we have a position in Marvell. So the way that we kind of think about it, Marvell is a digital infrastructure play. If we think about AI, mixed reality, augmented reality, and all these other things that are driving this virtuous circle of content creation consumption, AI is just another factor that's going to drive network capacity higher, fostering upgrades to the network.
Yeah, that makes sense, given what we've seen from some of these stocks. Chris, you're going to stick with us because we have another topic that we want to touch on, And that has to do with food of a different kind. Cava giving Wall Street its first major restaurant IPO since Sweetgreen in 2021. So far, it is leaving some analysts a little bit skeptical here. With a $22 per share initial public offering price, the fast casual restaurant is currently priced to grow faster than competitors like Chipotle, despite being less profitable and having perhaps more competition than Chipotle did at its IPO. New Construct CEO David Traynor is not optimistic about Cava's chances. In a recent analysis, Traynor found that even if the company grew at 1.5 times the industry, the midpoint share price would be $7 a share, not the suggested, $22 that we talked about. So is this too good to be true? We're back with Chris Versace, Tematica Research Chief Investment Officer. We have been having a lot of discussion about Cava at the office because there's one up the street. It's one of my favorite lunch places. Does that mean it's a good buy? No, not necessarily. But it is, to me, we were talking about Chipotle being kind of the closest analog in terms of the style, right? It's effectively like a Mediterranean or Greek Chipotle in terms of getting your bowl and picking things to go in the bowl. But Chipotle was the pioneer here. Cava is coming when did Chipotle come public? A while ago.
The debate we had this morning, is this another Chipotle or is this more like a Sweetgreen?
Yeah.
From a stock perspective, how do you look at it?
It's a great question. I mean, when I look at restaurant stocks, right, and this includes everything from Portillo's to Dutch Bros to anybody, and the recipe is similar, right? When you look back at Starbucks or Dunkin' or McDonald's, it's all about footprint expansion. So you have to ask yourself, how are they funding this? How fast are they expanding the footprint, right? Those are the key questions in my view. But also, given where we are now, what did Cava do in terms of price increases in last year? And is that, like we're seeing with Chipotle and others, are those becoming margin levers now because food costs are starting to come down? So those are the two big questions that I have, but I'm also cynical enough to know that given this is a new IPO, the company probably knows pretty well what it's going to do for the first 2 quarters, right? You don't come out of the box and try to underperform. If it happens, it tends to be a disaster.
$2.5 billion? Is that what this company should be valued at?
I mean, look, the market set the price, right? So now the question is, what are the follow-on research people going to say? I suspect that, the underwriters will, again, not to be cynical, support the stock. So, as an investor, I would just kind of sit back and wait and kind of see what develops. I would not be chasing this in the near term. Having said that, do I go to Cava? Do I like Cava? Absolutely.
We all eat at Cava. We've established that it's good food.
It's excellent food. It's excellent.
To broaden it out and talk about the IPO market a little bit, it's been a lackluster year for IPOs thus far, not surprisingly, right? And so it's interesting to see that it is such a consumer-facing name come out here. But do you have a view on IPOs as an asset class, or do you think it's just you got to look at them individually? It seems like there's some enthusiasm here after the capital markets have seemingly been closed for a little bit.
Yeah, I mean, Cava is one of the first hotter IPOs coming out of the market. I mean, it's been very, very quiet, over the last 3-4 quarters, and so much so that you've seen some of the investment banks make layoffs, right? But there seems to be a tide turning. I was reading yesterday, I think, that Goldman Sachs IPO indicator seems to suggest that the second half of the year might be a little bit stronger. So we'll see. The fact that the market is doing, has been doing well, the fact that Cava leans into an area of strength, like we talked about in terms of retail sales year to date, that has some merit for it, but I think you really have to assess the individual opportunities, no question.
Is that what's driving the enthusiasm? I mean, we're talking about Cava today, but a number of other restaurant brands also looking to come to market. We're talking about Fogo de Chao is one, Panera potentially, Fat Brands. Is that where the appetite is?
No pun intended.
No pun intended. I can't avoid the word. I felt the need to not even say that. I've been using so much, but...
Well, I mean, look, companies look to tap where there's market strength, right? And we know that consumers have been eating out. Really ever since we started to emerge from the pandemic, it continues to be strong. So it's not surprising.
I guess not. All right, well, stay with us, Chris. We're going to move on and also remind folks that we're going to talk to Cava a little bit later. Our own Brooke DePalma is going to interview Cava CEO Britt Schulman. That's going to be right here at 11:50 a.m. Eastern. They will be on the floor of the New York Stock Exchange. So she's going to be asking him some of these questions that we have been discussing. I want to know what his favorite bowl is. I don't know. Maybe we'll find that out too. Tesla, meanwhile, may have snapped its 13-day winning streak, but its competitor Nikola is showing no signs of cooling down, surging in pre-market trading. It's up 13%. It's been doing that for the last few sessions. What's going on here? We don't know. Yahoo Finance's Pras Subramanian joins us now. Pras, what's interesting about Nikola is, right, it's no longer really part of the EV conversation when we talk about EVs. What is Nikola doing now? What sort of set the stage for us? Like, what is the status of Nikola as a company?
Yeah, it's a bit of a funny story here with the stock moves. We're talking about stock that's below the buck for quite a while now. There's no real news here other than the fact that, about a month ago, they had split their operations with IVCO to give IVCO their European operations, and they're going to focus more on North America. For its part, Nikola says that it's going to keep building its EV trucks and also its hydrogen fuel cell semis. So that's still happening. They're slowly trickling those out. But yeah, there's no real news here other than the fact that a lot of EV stocks have been moving up really highly recently, along with the tech trade that we obviously mentioned, talking about the Fed rate pause and good CPI data. So there's that behind it. But there's no real news here for Nikola. You got to be a little cautious here. Maybe there's a short squeeze, some tricky options plays. Who knows? But it kind of reminds me, Julia, of the meme frenzy from the pandemic.
Yeah, remind me, is Nikola selling any trucks yet?
Yeah, they have a couple lines in operation. They're building a medium-duty EV truck that they've been building for some time now. They've only built a few of these, and then they're focusing more on the hydrogen fuel cell semis. That's the big thing that they think is the future, and they're working with IVCO on that, and they kind of split operations. And I think IVCO is still a big partner for them in terms of a production partner. So it's happening, but it's very slow. We're talking about tens of 20 trucks maybe, not that many.
Yeah.
And to your point, Pras, even though it's up significantly, we're still talking just over $1 here. Yeah. So all relative. But Pras Subramanian, thanks so much for that. I want to bring in Chris Versace back into the conversation, Thematic Research Chief Investment Officer. Let's put Nikola aside, because Pras brought up a good point that it does feel like there is this enthusiasm once again around EVs when you think about what's been happening with Tesla as well. Sure, there was that announcement with a partnership with GM as well as Ford, but is there a bit of FOMO trade happening? I mean, you talk about AI as one.
Yeah.
EVs.
So I think we've seen waves of that, to be honest. I think we're kind of seeing some nice movement in the stock prices. You look at Ford over the last couple of days, going from, recently between 11 and 12 over 14, closing in on 15. My concern here, just trying to capture the conversation we had earlier too, is, if rates do go higher, that means borrowing costs are higher. That's another headwind for automotive loans, right? Because they will tick higher too. So the whole thing that's fascinating to me is the real transformation in this industry where everybody, right? Ford, GM, Stellantis, Ferrari, Volkswagen, they're all leaning into this EV transition. And there are reasons for it, including some, at least here in the States, some tax credits. They're helping foster, EV adoption, right? There's some, EPA regulations and all this other stuff that are going on. So the industry's moving that way. I just think that, it's possible that it might take a little longer than expected to hit some of these forecast numbers that are out there. And at the same time, right, you have to ask yourself, okay, companies are spending and investing to do this, but if we do see a slowdown because of higher borrowing costs, what does that mean in the near term for their profit picture? But
to pick up on that point about the higher borrowing costs, you were talking about tech earlier. We saw these stocks get hit at the start of the rate hiking cycle, right? The expectation was that these companies aren't necessarily profitable. They've got a lot of debt. These are the companies that are going to get hit as a result of higher rates. And yet it feels like we're kind of back to where we were before that in terms of the enthusiasm. Sure, in tech you can talk about AI specifically, but EV, the growth has been happening. Why now? Why are we seeing this kind of
I think you
rally?
I think you got to kind of differentiate, right? So there are some larger established players like the ones that I mentioned, Ford, GM, and then there's the ones, the Rivians, the Nikolas, and the like. And it's very simple. You can't churn out, what would we hear, 10, 20 vehicles, right? And that's not going to cover the cost of your operation. So I think there's a reason that some of these stocks are down towards the bottom. But I also think, though, too, if you look at the automotive industry from a structural perspective, it really tends to solidify around a handful of players. And again, if you take another look at it, you look at consumer electronics or some others, the vast majority of market share tends to be concentrated around, again, a handful of players. Will all of these companies make it? Probably not.
I feel like the Nikola part is more memey than anything else, right? I mean, it does feel like it's interesting to me that the meme stock raise has persisted in different ways. It's more like little flare-ups of these individual situations and short squeezes, perhaps. For example, Nikola, something like 20% of its float is shorted. But I don't know how much at one point it felt like investors needed to pay attention to it to some degree, other investors who weren't part of it. Now it feels like you can kind of ignore it. I don't know.
It could very well be people are just looking for a quick trade too.
Yep.
Yeah. Yeah, that's a thing that happens. All right, Chris, stick around. We're going to have the opening bell in just a few moments. And coming up, making Europe a top priority, China's corporate behemoth Alibaba is setting its sights on the continent. But how much has that got to do with China's regulatory crackdown? We'll discuss that and all your movers next.
Well, let's take a look at some stocks that may not be moving markets today, but our guest thinks deserve some recognition. Let's bring back in Chris Versace, Tematica Research Chief Investment Officer. We were talking about EVs before the break. There's a play in there somewhere that you're liking, right?
Yes, there is. It's a company called
Infrastructure is what we're talking about.
Well, infrastructure, yeah. So there's a couple different aspects to the infrastructure bill. With regarding EVs, I actually like ChargePoint. Ticker symbol CHPT. It's a play on the pain point, right, as we see EV adoption, right? All these cars moving around, they do need to be charged, right? So that's one that I really do like. And you look at the share price where it's kind of pulled back a little bit. We have a $15 price target on it, and we own it, just to be clear, in the Action Alerts Plus portfolio. We like it as a longer term play. So that's
why hasn't it done better? I mean, we had the infrastructure bill passed. In theory.
So it's a great question. No, it's a great question. So the way I kind of think about it is, if we were to go back, 2 or 3 quarters ago, we saw more typical infrastructure companies, Vulcan Materials, United Rentals, which we also own in the portfolio, which we also like quite a bit. They were kind of starting off, and then they kind of languished, right? What we were waiting for is confirmation that, yes, the spending is ramping. And when we look at that type of construction, we get the monthly construction spending data out, and non-residential construction in particular has been strong and strengthening over the last few months. And that's why you've seen like United Rentals go from around $330 a couple weeks ago to right around $395, $400 as of earlier this week, right? So the market's looking for confirmation. I did a podcast conversation with Orion Energy, and they do a couple different things, including building EV charging stations. And they confirmed that, yes, the bill has been passed, the funds are weaving their way through, right? And they need to get into hands, products need to be developed, plans need to be laid, that sort of thing. So we should see strength from that side of the infrastructure bill really start to pick up in the second half of the year.
But were you surprised by the reaction, the stock reaction on the back of this announcement between Tesla and Ford and GM?
No, I wasn't, because
ChargePoint still benefits, right? The more adoption there is, it's not like ChargePoint. Tesla's win comes at the expense of ChargePoint.
Music to my ears, because you're 100% correct on that. So there seems to be, and I made this point. If we were talking about regular infrastructure, right, we wouldn't be like, oh, only Caterpillar's going to win, or only this company is going to win. You would say, wow, there is a lot of spending coming. It's going to be a rising tide that lifts a lot of boats. And it's the same thing here. But for some reason, right, whether it's ChargePoint, EVgo, Blink, they have been kind of in this war, if you will, with Tesla shares. Because late last year, earlier this year, bad news for Tesla hit the EV charging stocks. And now there's been some headlines, understandably so, that Tesla is making these partnerships. So the thought process there was like, oh, this can't be good for anybody else. And then we find out, no, this is just a connector. And oh, guess what? Tesla, with Ford and GM, they're influencing what's likely to be the standard. And everybody else comes out and says, we'll have those connectors too. We're back to a rising tide.
Well, I mean, if you think of it as it's like gas stations, right?
100%.
Like, it's not like people buy Shell over Exxon because they have more gas stations.
By the way, Tesla drivers already go to ChargePoint. You just add an adapter.
That's correct.
Yeah.
Yeah, you're both making excellent points, and it confirms what I'm saying, so I love it.
There's one other stock that you like that I want to pinpoint because it had a really bad day yesterday. I'm talking about United Health. After the company came out and issued a warning, said loss is going to be climbing because people are doing more now, elective surgeries coming back. So their costs are going to be going higher. It was a really interesting day because United Health doesn't tend to move that much usually, but it plunged. Other health insurers plunged. So why are you looking at it?
So we're not actually looking at United Health, right?
Oh, okay.
So in the portfolio, we have a company called Elevance Health, okay? Mm-hmm. So similar, and did it get hit yesterday? Of course it did. A whole kit and caboodle, including CVS, got hit. So I think it was kind of a knee-jerk reaction. From my perspective, we've been liking picking up shares of Elevance Health between 440, 450, something like that. And this kind of knocks it down below that level. The funny thing is, the day before, Elevance, getting ready to make the investor conference rounds, came out and reiterated its guidance, which says, hey, we're going to grow our earnings 12.5% in 2023. So I think when you contrast that, if Elevance was seeing what United was seeing, they wouldn't have said that. So I think that's an opportunity for ELV shares. And again, you really need to understand, just in general as an investor, what you own and kind of what's pushing on those respective businesses.
Differentiate even within the same sector there.
100%.
Chris, it's good to have you on today.
Thank you.
Thanks for sticking around. Chris Versace, Tematica Research Chief Investment Officer. Time now to turn our attention to the markets here at the open. kind of a flat open here. We're looking at the Dow up just 10 points, the S&P 500 and the Nasdaq both down right now. Investors obviously sort of digesting the news from the Fed yesterday, really a pause, skip, however you want to characterize it, but also really looking ahead to those forecasts from the Fed and potential for those additional rate hikes. In terms of sectors that we're watching right now, we are seeing, what are we looking at? Health here, seeing the biggest gains at least so far, healthcare as well as energy stocks. Julie, over at the Touch here to take a look at some of the early movers.
Yeah, and I want to take a look at the S&P over the past couple of days because this encompasses the move that we saw yesterday in reaction to the Fed, right? So here was yesterday during the day, kind of plugging along, and then we had all of this volatility in the wake of the Fed rate decision statement, and then, of course, press conference and the confusion over what's going to happen next on rates. That debate continuing, and we're going to talk more about that in the next hour. But over the last 2 days, all of that equals just 0.1% move in the S&P 500. If you narrow that to today, it's about the same. So not seeing a lot of movement on that level. So let's take a look at other areas here. We just heard Akiko talking about sectors. Let's take a look at the sector view here. Energy and consumer staples up the most in the S&P 500 today, and then we have consumer discretionary and real estate and communication services taking a hit in today's session. We'd like to look at the Nasdaq. I've been talking about the connection between these large cap tech stocks and what we see with rates and this inverse relationship that you frequently see here. But there's not a lot of direction here one way or the other. I mean, Apple and Microsoft slightly higher, Nvidia taking a hit down 1%, Tesla, which we're going to talk about more later in the show, down 2% after that incredible, let's take a look at the month chart here in Tesla, that incredible run that we had in Tesla of 13, 14 days higher, now taking that little tick lower, but it's still 51% higher on the month. So we are just seeing maybe a little bit of a pause today as people digest the Fed and figure out where they are going next. One of the other things that we've been watching that has been on the move has been what's been going on with the cryptocurrencies. We see Bitcoin pulling back 3.6%. We see Ethereum pulling back by 5.7%. Now, I mentioned rates, so I do want to go to rates for just a second here to show you what we are seeing on that front. The 10-year yield going down. Not much, little change, 3.74%. Let's take a look at the 2-day for that as well here. So yesterday, that blip up, but this is not a chart that suggests that the market is convinced we're going to see 2 more hikes this year. But again, we'll be talking more about that later in the show, Akiko.
Yeah, I was going to say we have 90 more minutes to talk about where things are moving there. But let's talk about some of the stocks we're focusing on today. Alibaba shares rising as the Chinese e-commerce giant is set to expand into Europe with a focus on building local businesses and online platforms outside of China. This move comes after China's central bank cut its interest rate. The country is getting serious about getting their economy up to speed after disappointing data from retail sales and unemployment. And we can get into that data in just a bit, but let's talk about Alibaba because this is a company that's really been in transition, right? After the big regulatory crackdown of the last few years, they've already said they're going to split up the key units within the company. Within e-commerce, there's the domestic facing side, there's the overseas side. Up until now, really the strength has been in Southeast Asia. Now they're making a big bet on Europe.
Yeah, it is interesting to hear that commentary and to see the stock reaction. I was surprised to see the stock reaction to this, in fact, that, it wasn't necessarily a throwaway comment, but nonetheless, the commentary that they're going to have Tmall also in Europe, interesting here. I don't know what the potential is. There is competition.
Well, I mean, that's the key, right? Is sure, Alibaba, this points to where they're looking beyond Asia, but can it actually do well in Europe is the question. And the model is a bit different than what exists right now, but it does feel like when you think about how Alibaba operates in the e-commerce domestic market, that is very, very tailored to the Chinese market.
Right. Is it translatable?
So how is it going to look when they actually go into Europe?
It's a good question. I mean, and then you have the China backdrop as well. When you go back to domestically, we did get more disappointing data today. Industrial output, retail sales slowing. But then, of course, investors' minds turn to stimulus and what the next phase of stimulus is potentially going to look like when you have that weak data. So sort of the phase that we were in at one time in the U.S. markets, right, is bad data good for the market?
Well, we were talking to Leila Miller yesterday from China Beige Book, who said it was never going to be a straight line up. When the zero COVID policies were put aside, things started opening up. We've been talking so much about the economy not picking up at the pace that was expected. But, we're still in June. Right? I mean, second half of the year, at least there seems to be a little more optimism going into that. Let's move on to another stock here. Lennar stock is on the rise after the company reported second quarter earnings and revenue that exceeded expectations. The company also surprised investors with their orders and deliveries with 17,885 new orders, roughly 18,000 there, and then more than 17,000 homes delivered. The earnings report was definitely unexpected given the housing market shift last spring and summer as mortgage rates rose. Signs suggest buyers are seeking newly constructed homes this spring. I mean, this really all comes back to inventory, that even with the slowdown in the market, part of that is about the mortgage rates going higher, but just the inventory isn't there, and that really opens up the opportunity for new homes to come online.
It does. And one of the other statements from Stuart Miller, who's the executive chairman, really stood out to me. He effectively said people are getting used to higher rates, which I thought was really interesting, right? Because you have a couple of possibilities among home buyers. They can hang around and wait for the rates to go down, right? If they're able to do so. Or they can say, okay, it's going to be this way for a while. Which I guess is kind of what the Fed would want. Well, it's not what the Fed would want. The Fed would want it to depress home buying
what do all
demand,
realtors say? Date the rate, marry the home? Am I mixing that up? Right? But the idea being that if there's a house that you like, okay, so you're not going to get back to 3%.
Right.
But this is still... It's all relative historically.
Yes,
if we're talking about
true.
6-7%,
Yeah.
And you can always refinance. At least that's what realtors have been pushing. I want to get back to a number, though. I think that really illustrates what Lennar's opportunity is here. Existing home inventory still 44% below pre-pandemic levels. So
and they're building a lot of homes. They said this year, now they're raising their forecast for how many homes they're going to build this year. 68,000 to 70,000 homes. That's up from 62 to 66,000 in their prior forecast. So they are churning them out right now, trying to take advantage of all of this. Let's talk about another mover that we're watching. That is SoFi Technologies, which is breaking a 9-day rally after Oppenheimer downgraded the company to perform from outperform. An Oppenheimer analyst explained in a note that the downgrade was based on valuation, concerns about management, and credit quality. And it comes after BTIG set a buy rating and price target of $14, making SoFi a top pick in the consumer fintech space. By the way, that 9-session rally for SoFi took it up by 43% to about a 15-month high. So we've seen these streaks recently, SoFi participating in that until today.
And it seems like on the back of the BTIG note yesterday, today is sort of just points to things running up too quickly. It is about the valuation.
It feels that way, right. So have fundamentals changed? Maybe not, but do you want to be paying for what these prices for the SoFi shares?
Well, and I keep going back to what the expectation was, at least we were talking about this yesterday, with some of these fintech plays. I mean, the thing that BTIG pointed to was their path to profitability, that it was more likely than some of their other competitors. And yet when you think about where it has been priced, what's more than doubled this year, if you look at where the stock is?
Yes. Yeah, it's just about doubled this year. One still outstanding item for SoFi is what's going to happen with student lending, right? It was seen as such good news that the moratorium was finally announced to be ended, eliminating an overhang for the stock, but we still don't know what's going to happen legislatively on student debt. So I think there are still some questions here for SoFi going forward, if any of that still continues to change.
Stock down more than 7% right now. Yeah. Coming up, on the other side, we're going to talk AMD versus NVIDIA. Much more to come here on Yahoo Finance Live. Welcome back to Yahoo Finance Live. Let's get to Yahoo Finance's Jared Blickery, who is standing by on the floor of the New York Stock Exchange for us. Jared, what are you watching?
Well, I'm watching the major indices, and I got some long-term perspective here the day after the Fed meeting, and let's go straight to the Wi-Fi Interactive so we can chart the price action. Now, first of all, yesterday, I got to say, S&P 500 closed barely up, but 6 points of that was relative, or was thanks to NVIDIA, one of those AI stocks that has really been fueling the rally, not only this year, but going back to October. And in fact, the S&P 500 would have been down 10 points without the so-called AI mega cap stock. So important to realize that that's this big dynamic in here. Second of all, that's a candlestick pattern that we're seeing. Second, the penultimate one, second to today, little doji formation. Now, sometimes that can display or show, I would say, indecision on behalf of traders, and you have to get confirmation. But today is green. If we close above yesterday's close, that is not a confirmed topping signal at all. And you want to take a look at the Nasdaq 100. We are now just edging closer to some really big levels. Here is a 3-year chart, and I want to point out that 15,000 has been in play in a major way, both to the upside and the downside. And having said that, guess what? We've blasted through some earlier areas that also could have given a little bit of a hiccup, and in fact that did not happen. The market was able to just power through them. So we need to observe, is the Nasdaq 100 fueled by those mega caps going to pause, or is it going to blast through once again? And of course, after it pauses, it could reverse. Enough of that, let's get on to the bond market. I'm still tracking the ICE B of A Move Index. I'm going to dial it down to a 3-month chart, and you can see just kind of consolidating underneath these lows we had for the year. Take a look at the VIX. So we just looked at bond market volatility. Now we're looking at equity market volatility right down by these June lows, which by the way are multi-year lows. So nice to see the bond market not really coming under too much pressure now. I'm coming around to the view that Powell and co. probably done. Well, yes, they could raise rates in accordance with what their summary of economic projections were indicating yesterday. They could raise another point, they could raise another time or two, but they're going to be, I think, very hesitant to break what is almost looking like a Goldilocks recovery. This has vibes of 2006, 2007, when the Fed went on pause. It looked like things were going to calm down. We were going to get a soft landing. Then 2008 erupted. I'm not saying that 2023 or 2024 has to look like that, but we should be open to the possibility because these things, especially when we're dealing with bear market forces and tightening by the Fed, these lag effects, these can have effects for months, if not quarters to come. Now, let's take a look at some of the sector action, and interesting to look at the leaders. Most of those have been in the value and cyclical sectors. This is today, energy on top, followed by staples and healthcare. A little defensiveness there, but you take a look at over the last 4 days, tech is the leader, and then you have materials, then consumer discretionary, then industrials. That is a pretty healthy mix of these mega cap and growth stocks, along with the traditional sectors that do well when the economy is performing well. So if in fact October was the low for years to come, this would be a very, very unusual bull market, as I've been saying, because usually everything goes up in the beginning and then you kind of sort out the winners from the losers. This was a very hesitant beginning. We had those mega cap names shooting up first, and now we're getting some support from the other sectors. But the bottom line is this rally needed breadth, and that's what it's getting.
Jared, on another note, just quickly here, it's the first day that you've had a big IPO there at the New York Stock Exchange in a while. Talk to us about what kind of crowd you're seeing.
This is a great crowd. I was struck immediately by how many people are in here. I haven't seen it this crowded in a long, long time. So this is a big IPO. No secret that the IPO and also M&A deals, all deals have been pretty much dead this year. You look at a chart of the new issues coming to market, it has flatlined after some really big years in 2021. Last year was a disappointment too. So if this is a bellwether of stocks, of companies feeling that they can come to market, tap the capital markets for the first time here, that is a very encouraging risk on sign. I think people are going to be looking at this maybe a little bit too much as a bellwether. If the stock ends up down today, does that mean anything in the long run? No. I think it matters that Kava is here today And thank you for the setup outside. It reminded me of a little Mediterranean lounge hangout out there.
Excellent.
I'm gonna go get some juice.
Yeah, do it up. Our Brooke DePalma is going to be down there later with Brett Schulman, the CEO. Looking forward to that. And thanks for a little bit of description of what's going on down there, Jared. Appreciate it.
You bet.
So AMD has thrown down the gauntlet. The California-based semiconductor maker this week unveiled its most advanced GPU for AI yet. It's being seen as perhaps the biggest threat to NVIDIA's dominance. Earlier this week, CEO Lisa Su told Yahoo Finance Live the technology is transformative, and the unveiling was a special day.
Everyone has, sort of captured this whole idea of chat GPT and generative AI and co-pilot functions, using AI to help us in our businesses, in our personal lives, making us more productive and more capable. And the underlying technology for that is GPUs.
All of this coming as Reuters reports Amazon Web Services is considering using AMD's chips. It hasn't made a final decision, though. Our next guest has some thoughts on the matter. Joining us now is Richard Windsor. He's founder of Radio Free Mobile. Richard's been covering the tech space for years, including 11 years at Nomura, where he focused on equity coverage of the global technology sector. Richard, thanks for being here.
Good morning.
So, is the right way to frame it to think about AMD versus NVIDIA, and that, one of these is going to be the winner in this AI situation?
It's a difficult one to say. So if you look, the situation at the moment is that NVIDIA is effectively a monopoly with probably around about 85% market share. And there's not just AMD in there. Don't forget, you've also got Google that makes its own chips. You've got some independent companies such as Graphcore in the UK. So there are a whole load of them in that space. AMD is probably one of the most significant challenges to date because they're going to sell the chip to everybody, but it remains to be seen how many developers actually want to use it, and that's going to be the key.
Does it have to be one or the other, though, Richard? I mean, you look at where the stock moved on that Reuters report yesterday. Well, we've heard over and over that the AI opportunity is so big, there's enough to go around. How do you view that?
It doesn't have to be one or the other. The problem you have, if you look at NVIDIA's valuation, is telling you exactly what the market thinks, which is it's going to be NVIDIA and it's going to be all of it. And so I think, there is a possibility that AMD does gain some market share. But what it really comes down to is NVIDIA has a massive lead in this space because it started a long time before anybody else. And it has managed to corral the developers. The developers say, we want to develop on NVIDIA silicon, and if you don't put it in your data center, we're going somewhere else. This is why Google Cloud and Microsoft signed deals with NVIDIA. So it really depends on AMD's ability to bring the performance and to make sure or entice the developers to actually say, yes, we want to develop on AMD.
Richard, from somebody who doesn't know, who's never coded, what makes it more attractive to developers, one versus the other?
Great question. Let me clarify that a little bit. Basically, developers like to have great support. They like to have great tools. They like for companies that they use to make their lives easy. Now, the thing is that the developers of AI training today all know the CUDA development environment, which is what NVIDIA uses, extremely well. I would have grave doubts that they know the AMD development environment as well. But what it's going to come down to is how well AMD can implement the other development environments that developers use to make it very easy for them and very efficient for them to switch maybe from NVIDIA to AMD with minimal level of disruption. That is the challenge.
Richard, there's a lot of investors out there who want to buy into this AI boom. I mean, specifically, we're talking about generative AI, but really looking at where the growth opportunity is. When you talk about a name like NVIDIA or AMD, we're obviously talking about the foundational things, the chips. Where are the other opportunities you see when you think about where AI can go?
Well, there's a couple of places you can look. So I view OpenAI effectively as part of Microsoft. So because I think Microsoft is going to have to acquire OpenAI at some point in time. So if you wanted to buy the OpenAI story, you could think about Microsoft. If you want to, another ways of looking at it is what are other companies that are more reasonably valued that have caught the AI tailwind? One of those is Palantir. Now, personally, I own Palantir personally in my own portfolio, and I own it because I think it's a great company and it has virtually no competition, and they're well ahead of the game and well positioned for this AI, for this current AI trend. The other one, of course, to look at is Google. You know, Google has massively underperformed if you think about it in AI terms compared to Nvidia or Palantir or even AMD. But Google remains, in my opinion, one of the leading AI companies in the world. They've just done a very bad job of getting that message across over the last few months.
Richard, if companies and developers are building their applications on top of ChatGPT, does that cut NVIDIA or AMD out of the equation, or are their chips and software still used in that process?
The answer is potentially. And the reason being is it comes back to that relationship with the developer that I mentioned to you before, is if everyone shifts from developing directly onto NVIDIA or AMD and they go, well, we'll just develop for ChatGPT, like a number of companies have done, you know, there's 140 different plugins that you can use to spread ChatGPT functionality across your app. If people go there, what happens is it moves the control point. It's instead of developers going, I want AMD or I want NVIDIA, they might go, I want ChatGPT or I want Bard. And what that does is it weakens NVIDIA's grip over that control point. It moves the control point further up the stack. And that is a potential negative for NVIDIA and also potentially AMD, because it would bring competition back much more into the silicon space, and those 70% gross margin that NVIDIA does a great job of printing quarter in, quarter out would come under some considerable pressure.
Okay, a lot of things to consider in the space there. Richard Windsor, Radio Free Mobile founder. Good to talk to you today.
Thank you.
Well, coming up, the Fed paused rate hikes yesterday, but signaled another raise might be right around the corner. We're going to speak with Wall Street Journal reporter Nick Timrose on the other side. just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Akiko Fujita alongside Julie Hyman. We are 30 minutes into the trading day. Let's take a look at what is moved since the open. We are watching shares of Kroger today after the grocer reported first quarter earnings this morning, seeing same-store sales increase 3.5% year over year. The company reaffirmed its full-year outlook despite net sales coming in slightly below estimates.
And shares of American Express are slipping this morning after Citi said credit card spending trends may be slowing, pointing specifically to travel and entertainment categories, which it says are slowing at a steeper trend than others.
Domino's is getting a boost today on an upgrade from hold to buy at Stifel, saying that carryout sales could be a significant growth opportunity for the company. Despite the upgrade, Stifel warns that the second quarter delivery sales for Domino's still may not show signs of stabilizing.
And the Federal Reserve has paused interest rate hikes after 10 consecutive increases, but signaled another raise may be right around the corner. Yahoo Finance's Jennifer Schomburger joins us now with the breakdown. Good morning, Jen.
Good morning, Julie. Call it a hawkish pause. The Federal Reserve decided to hold rates steady on Wednesday at its policy meeting to take a step back and assess more economic data. But it's still forecasting 2 more rate hikes this year because inflation has been slow to come down. Take a listen to Chair Powell.
If you look at core PCE inflation overall, look at it over the last 6 months, you're just not seeing a lot of progress. It's running at a level, over 4.5%, far above our target, and not really, moving down. We want to see it moving down decisively. That's all. Of course, we are going to get inflation down to 2% over time. We want to do that with the minimum damage we can to the economy, of course, but we have to get inflation down to 2%, and we will. And we just don't see that yet.
The Fed sees inflation ending the year higher than previously thought, closer to 4% compared with 3.6% previously. And for that reason, officials see more rate hikes this year. Take a look at the interest rate projections that were released at Wednesday's meeting. 9 officials think 2 more rate hikes would be appropriate. That would bring the policy rate up to a range of 5.5% to 5.75%. 4 officials want just 1 more rate hike. That would bring rates up to a range of 5.25% to 5.5%. And 2 don't want any more rate hikes. Now, Fed Chair Powell said that now that the Fed is closer to the peak rate, it's not a matter of speed. He said now the committee can afford to moderate the pace of rate hikes to give the economy more time to adapt and make better decisions on interest rates. Powell said the committee did not make a decision about what will happen at the next meeting, nor did they talk about adopting a strategy of hiking every other meeting, though Powell said that every meeting will be live. And while the Fed chair said July would be a live meeting, he did not tip his hand, though markets are expecting a rate hike in July. Take a look at the CME Fed Fund futures this morning. They're pricing in a better than 70% chance of a rate hike next month. Goldman Sachs chief economist Jan Hatzius is one of those who thinks that the Fed will hike in July. But after that, he's surprisingly not forecasting more rate hikes, despite 9 officials seeing 2 more rate hikes this year. He says it's possible if inflation remains elevated, you could see the Fed hike again in November over December. And at that point, he expects the Fed would be done. Ladies?
All right, Jen Schomburger with the roundup there. Thanks so much for that. Well, the Fed has signaled its fight against inflation is ongoing despite its decision to hold rates steady in June. When asked about the choice to hold during the press conference yesterday, Fed Chair Powell defended the FOMC's reasonable choice to slow the pace. Take a listen.
Why not just rip off the Band-Aid and raise rates today?
So first I would say that the question of speed is a separate question from the question from that of level. Okay, so and I think if you look at the SEP, that is our estimate, our individual. It's really accumulation of our individual estimates of how far to go. I mentioned how we got to those numbers. In terms of speed, it's what I said at the beginning, which is speed was very important last year. As we get closer and closer to the destination, and according to the SEP, we're not so far away from the destination in most people's accounting. It's reasonable, it's common sense to go a little slower.
Let's bring in Nick Timros, Wall Street Journal's chief economics correspondent. He joins us now. Nick, that was your question there, and I'm curious to get your read on the Fed chair's response to that and what that says about how he's keeping his options open, especially with the economic data that's likely to come between now and July.
Yeah, it's a good question, Akiko. Thanks for having me. I guess there are two ways to think about what the Fed is doing here. One way that they've communicated this is we just want more time to look at the data. So they had 6 weeks of data between the May and the June meeting. They'll get another 6 weeks of data between the June and the July meeting. And that, that case it's a little bit confusing, I think, to people because they're looking at the warm-ish data that we had between May and June and saying, well, if you didn't increase interest rates on the basis of that data, do you need to see even hotter data over the next month to go in July? And I don't think that's the case here. So the second explanation for what they're doing, which is what Powell essentially teased, I think, in his answer there, is that they're moving to a quarterly baseline pace of rate increases. And so you want to look at 3 months of data instead of 6 weeks of data. And if that's the case, then they already have more than half of the data that they're going to get before the July meeting to make their decision. And that creates, I think, that's why you see the expectations of another increase in July is just because they didn't raise in June on the basis of that slightly firmer inflation and activity that we saw in May and early June doesn't mean that it has to get dramatically worse for them to go in July.
So, Nick, to your point, I mean, this kind of also goes to the question that Bloomberg's Michael McKee asked, which is it time or is it data? In other words, if you get to the next meeting and nothing has changed, do you go ahead and do the rate increase? And in your mind, is that indeed the base case here, given what we heard yesterday?
I think it is. I think it is. And it could get confusing and messy because people always say we're going to know a lot more in 6 weeks, but often you don't, right? Things have been confusing all year long. There hasn't been a clear upward or downward move in inflation, right? Things have just sort of, they've gotten a lot better on headline, but not a lot better on core. Again, it's the clip of Powell that you played showed. So it's hard, but not impossible to come up with a list of reasons why the Fed might not hike in July. You could see a weak payroll report, but we haven't had any weak payroll reports in the last year. You could see more banking or financial market turmoil. You are going to get second quarter earnings later in July. Investors will want to look at what net interest margins have been for those banks that lost deposits. Have they had to really pay up for deposits? And so is the profitability of these banks really going to be a serious concern? You could get some other unanticipated shock. You're going to get one more inflation report, and people say, well, what about a weak inflation number? Would that be enough? I don't think it would. Listen to what Fed Governor Chris Waller has been saying for the last year. They don't want to be head faked by one positive inflation report because that's already happened a couple times now where they got some better inflation data in the fall and then it got revised away. They had better inflation data in September, August of 2021, which led them to hold on to the transitory explanation in hindsight longer than they should have. So 1 week inflation report here, the June CPI, may not be enough to hold them back from hiking in July. And so it really raises the question, how much weakness would you need to see in the other data? And will you actually see that weakness? I don't know.
Nick, you mentioned the stress in the banking sector that we've been seeing. We had a guest on yesterday who seemed to suggest that the primary driver for the pause or skip that happened yesterday was because of what has played out within the regional banks. The Fed chair was asked about that yesterday. He didn't really answer the question. What's your sense on how big of a factor that's likely to play on the pace of these hikes?
Yeah, I think all things equal, the banking stress did play a role in this idea of spacing out these next few moves. You get more time to see what's happening in the economy and in the banking sector. What's interesting is that, before the run on Silicon Valley Bank, Powell had basically signaled that they were shifting their base case terminal rate up to 5.6%. Then they ended up not doing that after the events of mid-March. They held their terminal rate steady at 5.1% in the March projections. And yesterday, what Powell essentially said was, we think we're going back to that pre-SVB terminal rate, but they're getting there over a longer period of time. And you can see the market is not at all convinced about that second hike that was penciled in yesterday. There seems to be, a high mass, a lot of probability that the Fed will go again in July in the market pricing right now, but not so much after that. And by spacing out those next few moves, you do give the economy and the data more time to decay and to sort of show the hawks on the committee, we really don't have to do this.
Nick, as always, there was a lot of commentary following the press conference about the effectiveness of the Fed chair's communication, right? Sort of saying it's a skip, I shouldn't call it a skip, sort of
right.
Maybe contradicting himself at times. Do you think that Jay Powell is sort of transparent to a fault, that he's communicating this way because he's sort of thinking out loud? I mean, you cover him very closely, so I'm just curious what your impression of that is.
I try not to get into opinions, but I think that's that's definitely a reasonable view. It's one that I've heard from others. I think that, as I think about Powell, I wrote a book last year that focused a lot on Powell. He's had two messages over the last year. The first message is the Jackson Hole message from August of 2022, which is, we have to stick with this, just like Volcker did. We cannot fail, right? That is sort of overarching message number one. But the second message, which is not contradictory at all, but does provide more nuance. We heard it at Brookings last November, and we heard it a little bit again yesterday, which is we don't want to crash this thing if we don't have to. He said at Brookings something like, I don't want to just raise rates, crash the economy, and then come clean everything up afterwards. And so long as they see some slim chance of a little bit of immaculate disinflation, a softish landing, then they're going to try to go for it. And I think that's sometimes why you get some of this dissonance, is people say, well, he's no longer doing the Volcker routine that he did at Jackson Hole. And you did hear some of that yesterday. They absolutely believe they can't fail on getting inflation down. But when you've seen headline inflation come from 9 to 4%, you've seen one-year inflation expectations come down, not quite as dramatically, but similar path, then you've removed that right tail risk of unanchored inflation expectations to some extent, and it does allow them to be a little bit more patient. On the other hand, Powell's also got to be looking at what's happening in Canada and Australia, countries that slowed down interest rate increases, central banks that paused earlier this year and are going again. And then you look at the UK and what's happening with wages and prices. They're absolutely not a place the Fed wants to be. So those are maybe cautionary signs of not unfurling the mission accomplished banner too soon.
So taking that point about not wanting to crash things if you don't have to, I mean, do you get the sense that given where the policy is right now and where the data is, that the Fed's kind of getting closer to that potential for a soft landing, that's an increasing likelihood?
I don't know. I mean, I talk to a lot of people in the markets who think that it's going to be harder to pull this off because of how much debt, how much companies borrowed and financials borrowed at low rates, thought rates were going to be low forever, and this higher for longer, even if the Fed doesn't keep raising. If they just hold above 5% for longer than a lot of institutions have expected, as debts come due, as loans roll over, you are going to see more stress. It's just we haven't gotten to those cliffs yet, and so you're not going to see it until you get there. But once you get there, you'll see it. So I think that's why the prospect of a soft landing maybe is fairly low. But there's a difference between having a mild recession and a really bad recession. And so you could read Powell at Jackson Hole as saying, it may be that we're going to have to go through a recession, but hopefully it won't be too bad. And the follow-up to that being, we really don't want to make the recession worse than it has to be if we're going to go into a recession to make sure that inflation doesn't stay out of control.
As one of our guests earlier put it, Nick, wouldn't want that job. It's not an easy one. Nick Timiraos, thank you so much. Wall Street Journal Chief Economics Correspondent. Appreciate your time this morning.
Thank you.
Coming up, we're not done talking about the Fed. There's another major issue that not many people are talking about. Find out what that is next.
Bonjour! The French Riviera may be famed for playing host to an annual star-studded film festival, beautiful aquatic scenery, and fine cuisine. But for 1 week, hundreds of billions of advertising dollars are at stake. It's the biggest gathering in marketing, media, and tech space. Cannes Lions and Yahoo Finance will be there, talking with C-suite execs from the household brands we all know and love. We'll also speak with some of the biggest profiles in entertainment, such as Cannes Lions 2023 Entertainment Person of the Year, Kevin Hart. Plus, international music artist and producer, will.i.am. 3 big themes coming your way. 1, generating demand during a discretionary spending downturn. 2, leading a values-driven brand through a polarized society. And 3, the role of artificial intelligence in advertising. Join us at the Cannes Lions Festival all week on Yahoo Finance.
Well, everyone is mostly focused on interest rates and the possibility of more tightening in the coming months from the Federal Reserve. Not much attention is being paid to the central bank's balance sheet. The Fed went from having less than trillion dollars on its balance sheet before 2008 to $4.5 trillion in the 2010s to almost $9 trillion after the pandemic. And as interest rates continue to rise, as is forecasted, this could keep getting worse. Here's what this means for the Fed and taxpayers. More on this is Judge Glock, a Manhattan Institute senior fellow and director of research. So, Judge, how should we think about the Fed's balance sheet here and the effect of its recent policy moves on it?
Yeah, so a lot of people forget that the Federal Reserve banks are also banks. They act like other banks in that they borrow money and then they lend it out again. Most of that borrowing is from their member banks. They deposit their reserves with the Federal Reserve. And then the Federal Reserve lends that money usually by buying out government bonds or mortgage securities. That hasn't been a problem historically because the Fed had usually didn't pay any money really for those reserves. But since the pandemic, they have interest on reserves, those banks that keep the money at the Federal Reserve itself. And now whenever the Fed raises interest rates, we hear a lot about the federal funds rate, but the real important interest rate is that interest on reserve rates. And so the Federal Reserve is right now paying about 5.15% to all the banks that lend money to the Federal Reserve itself. The real problem is that's more money than the Federal Reserve is getting on its assets, all those Treasury and mortgage-backed security bonds they bought over the past 10, 15 years. And that's going to be a problem for the taxpayer and maybe even the Federal Reserve itself.
So how effective has the tightening of that balance sheet been?
Well, it's had a real effect. So according to the most recent Federal Reserve release, the Federal Reserve has lost about $65 billion over the past 8 months. That's not chump change. The Federal Reserve, again, pays about 5.15% in interest. All those mortgage-backed bonds and Treasury bonds they bought during the pandemic, even during the financial crisis, those pay about 2.5%. So not too dissimilar from the sort of problems you saw at places like Silicon Valley Bank, at First Republic and others. They were borrowing short, lending long, and then when those interest rates inverted, you started to see a lot of problems on their balance sheet.
But what are the implications here for the Fed? I mean, the Fed's not going out of business.
No, the Fed can always print its own budget, and that's a nice advantage for the Fed to have. But, there are political consequences for this as well as for the taxpayer. So about 10 years ago, Jerome Powell himself, when he was just a Federal Reserve board member, said, realized what would happen if they kept buying all these securities and interest rates went up, that the Fed would start losing money. He said, well, what happens if we're paying billions of dollars a year in interest rates to big banks and not giving any money to the taxpayer in a time of fiscal austerity? That's going to look bad politically, and that is exactly what's happened. So again, it's about $65 billion they've lost directly over the last 9 months or so. If you do a mark-to-market accounting on their bank balance sheet, again, similar to what people have talked about for Silicon Valley Bank, you're looking at losses about $1 trillion. This is significant, and somebody somewhere has to pay that. And what that means is the taxpayer is going to have to pay that. They're not going to get the income from the Federal Reserve. The Federal Reserve says it won't be giving money back to the Treasury, maybe for up to a decade. That might make some Congress members, especially during a time of fiscal austerity and tightening, a little bit angry.
And then let's talk about the flip side of this, which is it is enormous, but they are starting to shrink that balance sheet as a part of their tightening. How should we be thinking about that as a tightening instrument versus interest rate increases, right? Because we know they paused, but they're still winding down the balance sheet. That is still happening.
Yeah. So obviously, if you saw that chart that you showed to your viewers earlier, you've seen a very slight decrease in their balance sheet since the peak in around 2021. But what you also saw is that when you had a little crisis, the Silicon Valley Bank crisis, they increased that balance sheet again, and it's only started to dip down again. And this is the tradition of what we've seen for the past 15 years. You've seen a very gradual attempt to wind down that balance sheet. Again, you see that after 2016 or so on that balance sheet. And then when the next crisis hits, it bumps right back up again. I think that's what we're going to continue to see until the Federal Reserve takes a very different path. If they keep increasing the balance sheet by hundreds of billions of dollars or trillions of dollars every time there's a crisis, we're never going to get that back down to a more normal level, which is hopefully what we all want to get, where the Federal Reserve is not giving so much credit to the economy, not deciding where certain credit goes in the economy and so forth. We want a Federal Reserve that's acting more sort of neutrally across the entire economy, which is not what they're doing right now.
So, I mean, what do you see as sort of the path forward? I mean, to your point, we're talking so much about the rates here. Obviously, the balance sheet tightening is part of that. How effective can that be moving forward if we're still paused come July and those rate hikes don't take shape, or the additional rate hikes don't take shape until later this year?
Well, the balance sheet tightening will have a small effect. The rates are the most important part of it, because like I said, when the banks keep that money at the Federal Reserve and they're telling banks how much money they're going to get for keeping that, that determines how fast the banks are going to spend their reserves on the balance sheet. So I think the more important part than sort of tightening for the overall economy is the sort of credit allocation question that the Federal Reserve faces. A significant part, trillions of dollars of the Fed balance sheet, are these mortgage-backed securities. That's the Federal Reserve itself deciding where certain money in the economy should go. And the larger the balance sheet is, the more of a temptation it is for politicians for others to claim, hey, we need you to fund this sector. We need you to fund this sector. You saw that during the pandemic. The Fed still has tens of billions of dollars of municipal debt on its balance sheet. It still has billions of dollars of the Main Street loans that were authorized in the pandemic. That large balance sheet really kind of looks like a honeypot to a lot of politicians, and it's a danger that they're going to take advantage of that unless they start tightening or start reducing that. And we've seen no significant indication they've been doing that over the past 15 years.
Judge Glock, Manhattan Institute Senior Fellow and Director of Research. Good to have you on today.
Thank you so much for having me.
And we are, of course, counting down to that first trade for Kava's IPO, I should say. We just got projections for that, now indicated to open between $31 to $33 a share. That's after being priced at $22 a share. Certainly, we have seen that demand going up. We'll see where it trades.
Yeah, we're going to hear from the CEO, Brett Schulman, a little bit later on to see how he's feeling about that and whether they can sustain that enthusiasm. Sweet Green didn't after it went public.
I know, enthusiasm is about it. I keep trying to avoid the word appetite in relation to Kava, but of course we're continuing.
Hunger.
We're going to continue to watch that throughout the morning. Coming up though, on the other side, feeling bullish, something of a rally developing for Netflix. Cowen, the latest to raise the price target on its shares, but how key will its sports strategy be going forward? We'll discuss next after this short break. Well, Netflix could be throwing its hat in the sports ring as it reportedly undergoes talks to live stream a celebrity golf tournament this fall. That's at least according to the Wall Street Journal. So what does this mean for Netflix's sports strategy, and how does it hold up against the competition? Let's bring in our very own Ali Canal with the details. And Ali, we have heard for years from Netflix that they don't want to get into the live sports game. It is about the content around the sports discussion. Is that going to shift?
Exactly. Well, they are experimenting with different ways to bring sports to their audiences, but it's a bit untraditional compared to some of those competitors. We've seen the tech giants like Apple, Amazon, Google really target those big partnerships with the MLB, MLS, NFL. But Netflix is doing something different. They're exploring sports documentaries with F1 in full swing. Now with this live celebrity golf tournament, they're going to bring some of those characters into that. So they're really creating these franchises around sports. So I spoke to an expert on this, John Christian. He leads an entertainment consulting company. I asked him, is this sustainable? Can Netflix not go after those spicy, not spicy, but although you could argue maybe pricey, I should say,
Spicy and pricey.
sports packages, which we've seen, they're very, very expensive, which is one of the main reasons Netflix has stayed away from that. And he said right now, they're just trying to focus on the technology, right? Making sure that they can get live sports tech right, because we know with the live Love is Blind reunion, that had some hiccups. And if you're a sports fan, if you're watching a game and something goes wrong, you're not going to be too happy about it. So that's priority number one. He said down the line, they might have to be forced to explore some of those pricier packages with those major league teams, or maybe even on the collegiate level with the NCAA. But right now, it's really all about creating these connections, right? Because sports fans, they're really the last frontier of the cord cutters. So there's a lot of untapped potential and a lot of opportunity to go after some of these games.
But it's also just more and more like cable. It's
that's what
it's like. What's the point? I don't know. It's just silly. Anyway, this you know what I mean?
No, I was trying to think of your argument on it's more like cable. I guess, I mean,
the more stuff they offer, then like, isn't it just like getting the cable bundle again?
it's still not the same.
It's still cheaper. It's still cheaper.
Yes.
Unless you get all of the
slowly
different...
creeping up, though, depending on how many services you have.
So exactly. So it's I guess what I'm saying is, what's the differentiation and the advantage at a certain point for, I don't know, the propositions just changes.
And at a certain point, I do think that's why we're going to see eventual consolidation with all of these services and all of these offerings, because people aren't going to go to all these different places just to access different types of games or different types of offerings. So that's something I think that we're going to see more of down the line.
Yeah. Meantime, we've seen Netflix shares rallying. They're up again today, and Wall Street has been quite bullish lately.
Oh, yeah, very bullish. I mean, the stock is up 50% year to date, more than 140% on the year. Investors are bullish. Analysts are bullish. The latest being Cowen, John Blackledge, boosting its price target to $500 a share this morning, up from the prior 440. Also reiterated his outperform rating. Now, he joins a slew of other banks boosting their price targets in recent days, including Pivotal Research, Wells Fargo, JPM, Bank of America. Pivotal Research currently has the highest price target on the street at $535 a share, but they're all pretty much in this 470 to 500 range, which suggests a lot of upside based on current levels. And you were just seeing on your screen 30 buys there, 24 holds, and 4 sells. And this really all has to do with the ad-supported tier, along with the crackdown on password sharing. Those are two big revenue initiatives. And we're talking sports, which Netflix has said it doesn't necessarily want to pursue. But when we talk about ads and the crackdown on password sharing, they've also said in the past that they weren't going to do that. They said there'll never be ads on Netflix. Now we have the ad tier. They said, we'll never go after your passwords. Now we're all feeling the impact of that. So that could be something that eventually, based on the competition out there, they could be forced to do.
It is about those additional revenue drivers, at least from an investor perspective that they see.
Yeah.
All about the money, baby.
Yes. All right. Thanks, Allie. All right, let's turn to another mega cap here. We're talking Tesla officially, at least for the moment, snapping its 13-day winning streak. It did flirt with going into, actually, it's up again right now. So it's not snapped that losing streak. It could be 14 days in a row, I guess. Or was it down yesterday? I guess it was down yesterday. All right, never mind. The gains grew the EV maker's value by over $200 billion. For more on the future of Tesla, we're joined by Tom Narayan, and RBC Capital Markets lead equity analyst of Global Autos. He's with us here in the studio. Hey, Tom. Hey. You were out with a note this morning that made a lot of interesting hypotheticals about how big the proposition is for autonomous driving for Tesla. I mean, you make it sound like robotaxis are going to take over the world and Tesla's going to have a big market share with this. Like, paint for us this future.
Yeah, and I think what's really pushed a lot of this to the fore is the deals that they've struck with Ford and GM, basically opening the supercharger network, and effectively these two OEMs coming to Tesla and choosing their platform. And I think this shows how they could sell software to other OEMs. The reason why robotaxis could be so transformational is their ability to save literally millions of lives. I mean, everybody in this room probably knows somebody who's been affected by a car accident, saving trillions of hours, opening up opportunities for mobility to the disabled. There's so many countless reasons why cities in Europe and China, for example, are already talking about banning private cars in the future, saving space and real estate in the cities. There's so many great reasons, and why regulators, I think, ultimately will push this. Now, this is far in the future. I do caveat that, but when you do the math on this, the potential for profitability of this is massive, especially versus just a car company.
Well, I mean, the point you make about robo-taxis and the potential for autonomous vehicles, I mean, that feels like that's an argument that's been around for a while, and the timeline keeps getting pushed back, but it feels like the approach from Tesla has changed. It used to be a lot more closed. This idea of essentially partnering with Ford and GM points to their now willingness, right, to be able to work with partners. How does that open up additional levers for the company?
I mean, you're exactly right? People thought it was a walled garden of sorts, but Elon Musk said on his shareholder meeting, he said flat out, like, we want to be like Android and really open up this software to everybody. My modeling that I did this morning for my $305 price target only assumes that they reach like mid-single digit percentage penetration on robotaxis in China and Europe, and only 25% penetration in the US. It's really through licensing. That's what's driving the story. It's only them and maybe a couple of other folks that are really pioneering and leading the charge on this. Just look at the FSD software that we have today. They're the only game in town that has as many miles on the road.
But this idea of opening up the walled garden, that's the analogy we want to use, how much of that was driven by the competition that is increasing in the EV space, the price cuts? I mean, we sort of look at these partnerships as if this is an all-win for Tesla, but doesn't that also point to the needs that Tesla now has?
Yeah, I think this is always the goal, always in mind, right? It was get as many cars on the road as possible, prove the technology, and then open up and license it to everybody. The reason why they're cutting pricing is they want EV penetration to increase. If your neighbor has an EV, you're more likely to buy one as well. The real denominator here is ICE cars. And opening it up actually increases EV penetration and also increases the chance that you'll see that their software is probably the best, if not one of the best, in the entire group. And there's only a handful of folks that are really doing this. And so this industry, robotaxis, could be multiple $1 trillion of opportunity. And these guys are one of a handful of folks who are actually doing it.
So when we're talking about your $305 price target, that's a 12-month price target. It doesn't sound like, I mean, if you're looking at a certain percentage of EV penetration, of robotaxi penetration, that ain't happening for
a long time.
5 years, 10 years?
No, actually, so
20 years?
Yeah, you're right.
Yeah.
So my robotaxi model uses a 2040 estimate and discounts it back. My FSD is 2035 and discounts it back. But even when I do that, I still get 70% of the $305 is robotaxis. Just because the value is so big. Think of how much you pay for Uber for a mile, and think of how much private car ownership is for you.
But you're
still willing to pay more.
But given that, when you increase the time horizon, you increase the unpredictability. I mean, there are so many other players that could come in and take some of that market share, no?
Sure, that could definitely happen. But how many other players have a $800, $900 billion market cap that can use the capital? Maybe Google, folks like that.
That's my question. I mean, who poses the biggest threat right now?
Yeah, I don't know if I view it as a threat, really. My modeling only has them capturing 20% of non-Tesla robotaxis. There's still 80% that can go to other folks, right? There are other companies out there. Your Mobileye, there's, Google, Waymo, GM has Cruise. There's other players out there. But at this point, how many are as well capitalized? We saw what happened to Argo last year. They couldn't just come up with the capital. You need a lot of capital to throw at this. And Tesla has that capital.
All right, we'll see what happens. Interesting stuff. Tom, thanks for coming in. Tom Narayan is our RBC Capital Markets lead equity analyst on autos. Coming up, more on the Fed's latest policy decision. Our next guest tells us what a pause in interest rates in the interest rate hike campaign means for the banking sector specifically.
Our job generally involves worrying about a lot of things that may go wrong, and that would include the banks. It might be hard for me to identify something that we don't worry about rather than that we do worry about. So we're watching those things very carefully. And as we see things unfold, as we see what's happening with credit conditions and also all the individual banks that are out there, we'll be able to take, to the extent it's appropriate, we can take, if there are macroeconomic implications, we can take that into account in our rate setting.
That was Federal Reserve Chair Jay Powell during Wednesday's policy meeting. Powell suggesting the Fed might need more time to see the implication of those banking sector stresses that roiled the financial system in the spring. Let's bring in Gerard Cassidy, RBC Capital Markets Managing Director who covers the banks, to weigh in. Gerard, this was something interesting also that Julia Coronado of Macro Policy Perspectives pointed out to us yesterday in the wake of the press conference, that perhaps the Fed would have hiked at this meeting were it not for SVB, et cetera, and the fallout from that still sort of percolating through the system. What do we need to be watching at the banks to see what effect interest rate increases are still having?
I think one of the real key metrics for the banks will be their deposit flows in the quarter when they report their numbers in July. I think what we're going to see based upon the weekly H8 data, which is the loan and deposit data published by the Federal Reserve, what you're seeing is a stabilization in deposit levels for the smaller banks, which during the middle of the March Madness, when those banks, Silicon Valley and Signature, failed, the outflows were quite pronounced. That has stopped. With the large banks are still being impacted by quantitative tightening, or QT. And as you know, QT is designed to take deposits out of the banking system to reduce liquidity. So I think watching the deposit flows and the levels of deposits in the second quarter results will be one of the metrics investors will be focused on.
So if we bottom line that, I mean, how elevated is the risk in the banking sector right now? And to what extent does that inform the Fed's timeline for another rate hike?
We actually believe the risk in the system is very low. What we have to remember is that the Silicon Valley, Signature Bank, and First Republic bank failures were idiosyncratic events. The mix of deposits for those banks was entirely different than your typical bank. And when you have banks like Silicon Valley, where the average deposit in an account was over $1 million, that's not normal banking. In America, when you look at the regional banks, many of them have average deposit sizes of less than $15,000. So in terms of a deposit flight or deposit run for the larger banks in the United States, it's just very unlikely. So I can see the Fed keeping an eye on it. You need to do that. But I think, the Fed's main goal, of course, is to fight inflation. And if they see inflation diminishing or slowing down as it has, hopefully it will continue to slow down. And this pause turns into a permanent end of rate hikes.
So all of this said, what does the profit profile of the banks look like right now in this environment? I mean, a rising rate environment in some periods of time tends to be good for the profitability of the banks. It doesn't feel like it's like that this time around.
It's interesting. It's a really interesting question, because when you look at the benefits of rising rates, it was quite dramatic in 2022 and in the first quarter of 2023. The FDIC put out the first quarter profitability numbers for the industry, and they were record levels. So the profitability of rising rates has been incredible for the banks. Now we're at the juncture, however, where the rising rate starts to work against the banks, because they have to now raise deposit rates more aggressively than they did in the past 12 months. The failures of these three banks have heightened the need to raise deposit rates as people are taking a closer look at their deposits. So as we go forward, the profitability of the group is probably reached its peak in the first quarter of 23, and we expect it to diminish. But the bank stocks have, we believe, oversold in anticipation of greater challenges. And on a relative basis of lower profitability, we agree with you, there are many that look very inexpensive.
You talk about rising rates starting to work against some of these banks. It's been particularly so in the smaller names. Are we likely to see more consolidation?
The short answer is yes. The longer answer, however, is it's on a pause. You might recall in the start of the 1980s, we had over 18,000 banks and thrifts in this country. We're down to about 4,700 today. The deal with First Horizon and Toronto Dominion being canceled by the regulators was a dark cloud on M&A. So right now, the Washington regulators are not in agreement on consolidation. We would suggest the Federal Reserve is very supportive of it, along with the Treasury Secretary, Yellen, but the FDIC and Controller of the Currency and the Consumer Financial Protection Bureau are not. So they all have to get on the same page, and they eventually will. But we think it's going to take a little while for that to happen. In consolidation, we expect to see it accelerate after all the new regulations, which are coming starting the end of the month. After they're all put out, we'll probably see a real pickup in M&A in the second half of next year.
Given all of that, Gerard, big banks or smaller banks a better buy right now?
It's really depends on the banking institution, because you can buy some of the big banks that are very attractive, like a Bank America, for example, or U.S. Bancorp. But then there are smaller banks like a Valley National or a Provident Financial, which are also attractive. So there are opportunities in these different markets for the size of the banks, but generally, so far year to date, the larger banks have outperformed the regional banks. And once we start to see some steadiness in the deposits from the second quarter results, the regional banks could potentially be the better beneficiaries because they have fallen further than the larger banks and therefore have more to snap back once stabilization comes to the deposit basis.
Yeah, always good to get your perspective in the sector. George Cassidy, RBC Capital Markets Managing Director. Appreciate the time today.
You're very welcome.
Well, Lennar's spring selling season started with a bang. The home builder beat expectations on the top and bottom line. Yahoo Finance's Danny Romero joins us with more on how home buyers are accepting the new normal for interest rates. The stock up in a big way, hitting a new high today.
Yeah, what a blowout spring selling season for Lennar. I mean, the report really shows that home buyers aren't really shying away from these higher interest rates. And for this quarter, Lennar reported new orders were up, especially in the East and West region. Lennar also worked through its backlog, which is very key for these home builders. They're down 29% for the year, and most of that backlog was actually in the West and in the East region. But the lack of homes for the resale market is really boosting Lennar to, up their guidance, their full year guidance. So they're expecting to deliver between 68,000 to 70,000 homes for the full year. And remember, builders are price takers. So Lennar has been slashing some of those home prices to really drive up demand. They've also been offering incentives like rate buy downs that really look attractive when a mortgage rate is close to that 7% almost. But however, some analysts on Wall Street are a little bit on the fence when it comes to Lennar. The fact that when they look across the board at all the home builders, they're against their peers like D.R. Horton, they're really a little bit on the fence because they say that Lennar isn't really in a position to grow when it comes to the volume of homes. So that is something that it will be up for consideration.
Lennar's on the higher end, right, of the home building spectrum?
It's affordable.
Okay.
It would be considered affordable.
Oh, I'm thinking Pulte.
Yes.
I'm getting my home builders mixed up. The conference call starts soon. So what are you going to be zeroing in on?
Spec starts is really a good gauge to really see how this home builder is going to look for the next quarter. And spec homes are unsold homes that have at least a foundation in the ground. And across the board, home builders like Pulte and Toll Brothers have really increased their spec starts. So it's a wait and see to see if they also echo the same sentiment as well.
Yeah, and it sort of comes down to what you've been talking about for a while, which is the inventory. It's just not there when you compare it to pre-pandemic levels. I mean, how long does this momentum continue for a name like Lennar?
I mean, I guess we'll have to see. The spec starts will really be that gauge to really, to see how the outlook will look ahead for that home builder. But I mean, across the board, they're increasing. So I'm assuming that Lennar will also increase as well. And depending on the region too, they've been focusing a lot on the East Coast and the West region as well, which is very interesting to see because of the home prices in those areas as well.
Yeah, always good to see the regional breakdowns there. Danny Romero, thanks so much. Well, we've got much more on tap all day here at Yahoo Finance. Brooke DePalma is going to be live from the New York Stock Exchange with the big IPO of the day. Kava CEO Brett Schulman on the back of his company's public debut joining Yahoo Finance Live. You certainly don't want to miss that, 11:50 a.m. Eastern.
Yeah, and the indications are for Kava to actually open above where it priced at $22. The latest indications that we saw between 38 and 40. That's the latest I'm seeing. Woo! Plus, is a commercial real estate crisis on the horizon? Rochelle Akufa is going to speak with a panel of experts in the next hour.
And stay tuned for our 3 to 5 p.m. show today. Pras Subramanian is going to be speaking with an executive from Rivian as it launches new retail spaces. EVs, a hot space.
Now, before we leave you, I do want to check on what's going on in markets here because guess what? Things have turned around. We're seeing all three major averages now higher. So we had sort of the negative rhetoric coming back into the fore after the Fed spoke yesterday. Are we going to see more rate increases this year? Did the Fed make a mistake in not raising rates? I mean, there's there's a lot of opinions, obviously, on what's going on here. I'm just checking on the sectors in the S&P. What's pulling us higher now is actually energy. Energy stocks doing well here. We've got healthcare also rising, tech also rising, real estate and consumer discretionary still falling back. But it's interesting to see energy doing so well in today's session. I haven't taken a look at oil prices in a bit. Let me pull up some oil prices here on the Interactive while we're talking about what's going on here at Kiko, but it's interesting to see that move in oil as well, maybe because we have seen a connection between, sorry, it's taking me a little while to scroll down to these oil prices.
Yeah, we're looking at Brent crude there around, what is it, $74 a barrel, WTI at 69.
Yes, exactly.
Still well above that $80 a barrel mark that we like to talk about, though.
Yes, definitely, but I wonder if some of the Chinese data today raising hopes of stimulus, and that then in turn helping some of these oil prices. We'll see. Rochelle Akufo has you for the next hour of trading. Have a great day, everybody.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Stocks shake off the Fed as investors digest the chance of 2 more rate increases this year. Expectations for any imminent cuts are mostly dashed. Investor bets on a July hike now sit at around 70%. We're across that story for you. And it's the biggest restaurant IPO since Sweetgreen. Carver lists on the New York Stock Exchange this morning with a valuation of roughly $2.45 billion. But can it justify some very lofty expectations? We ask CEO Brett Schulman this morning. And AMD threw down the gauntlet this week. The California-based semiconductor business unveiled its most advanced GPU for AI yet. It's being seen as the biggest threat to NVIDIA's dominance, but is it really? We talk AI wars coming up this hour. But first, let's check in on the major indices here. Picking up some ground, as we mentioned, they're shrugging off the Fed's more hawkish tone about rate hikes ahead. The Dow now up more than 270 points, or 0.8%. The S&P 500 also up about 0.5% there, and that's being led up by energy. And also take a look at the Nasdaq, they're up about 53 points on the day, or 0.4%. Let's also check in on the Treasury market because they're not fighting the Fed. They do see some risk ahead. We're seeing here the 5-year down by about 2.33%, the 10-year down by just over about 2.2% there roughly, and the longer-term 30-year yield there down 1.8%. Well, we've heard a lot about the Fed these past couple of days, and while it's interesting and important, it's also full of jargon. So here to break down some of those terms for us is Yahoo Finance reporter Jennifer Schonberger. Now, Jennifer, we know you cover all of this, so let's start with this new one that has come up since the Fed's decision yesterday, a hawkish pause. What exactly does that mean?
Hey there, Rochelle. Yeah, everyone's calling the Fed's actions yesterday a hawkish pause. Basically, that is a shorthand way of saying that the Fed wanted to take a step back and assess the 10 interest rate hikes that is done so far over the past almost year and a half, as well as wait to see what incoming economic data tells the Fed, therefore the pause part of it. But officials also set the table to do potentially 2 more interest rate hikes, hence the hawkish part of that. But then what exactly does hawkish mean, right? We hear a lot of people throw around the terms of hawks versus doves when it comes to Fed speak. Essentially, hawks or hawkish are officials that want to raise interest rates. They like higher interest rates. And on the flip side of that, doves are those that want to keep interest rates at current levels or perhaps cut interest rates. They favor lower interest rates.
So then, Jennifer, what about tight policy versus loose policy? Could you break that down for us?
Yeah, exactly, Michelle. So we talk about hawkish versus dovish, and that leads into tight versus loose. Essentially, hawkish can equate to tight policy, which is higher interest rates, raising interest rates. And on the flip side, dovish or loose, even easy policy means cutting rates.
That's interesting. Hawkish skip almost sounds like a dance you'll see on TikTok, but obviously something investors should be taking a lot more seriously. Thank you there. So there you go. There you go. A very own Jennifer Schonberger. Thank you so much.
Thank you.
Well, bond traders are betting on a Fed-led recession later this year, and investors are now wondering where to put their money in anticipation of an economic slowdown. Now, is the rally in tech a safe bet, or should you take your profits and move on to another sector? Joining us now is Brian Bendig, MJP Wealth Advisors President, to give us his take here. So, obviously, depending on whether or not you think we are already in a recession or heading for one, or a hard or soft landing, how do you position yourself for this sort of environment?
Good morning, Rochelle. I think that obviously is the critical question of where is this all going to go? Because there are so many conflicting variables right now. And I think in the short term, what we're seeing in some of the forward-looking indicators is the economy slowing. And the answer is we think yes. We've seen some higher claims data come in from unemployment over the last couple of weeks that show the 4-week average increasing. We're seeing that spending from the consumer is still occurring and is maintaining current levels, as we've seen with retail sales recently, but we see debt levels are increasing. And I think the other part too is that with inflation coming down, as we've seen month over month quite consistently, the question is, can companies still maintain profits and margin in this environment? And is there a lower likelihood they can pass that price along? And so as a result, around the corner, we have July earnings. And with that being said, I think it's a really good test to see the quality of earnings and the fundamentals. Do they support these valuations? So from a positioning perspective, I think you need to assess those fundamentals before you continue on with this AI frenzy that has lifted the markets higher this year, and look for some other areas of the market that haven't participated in the bounce back. And at the same point in time, I think with interest rates being maintained and then, as we know now, increasing over the balance of the year, I still think fixed income in different parts of the yield curve do look attractive over the next couple of years for investors.
Because it can be tough. I mean, we're seeing the major indices shrugging off the Fed's warnings here. Bonds telling a very different story. Treasuries telling a very different story. So what do you chalk that up to then, if you have this sort of these two different directions that the markets and the bonds are going in?
Well, I mean, I think that's been the classic case between bond investors versus equity investors. Fixed income investors are a little bit more focused on what's going on with some of the macroeconomic as well as economic indicators. And equity investors are looking at what makes sense to pay for a premium or a multiple on growth or cash flows in the future. And I think the point that I want to point out to the audience is the fact that right now, the multiple that's being put on sales from technology companies start to rival levels that we saw back in the late 1990s, specifically 1999 into 2000. So again, does the fundamentals of those companies support those valuations moving forward, knowing that interest rates are still going to go up? And what I'm trying to say is possibly not, that we should probably expect some sort of pullback from the mega cap tech perspective over the next couple of months, because there's about 490 companies that have not participated in this market. And I think as the economy continues to slow, those companies probably will get a bid. On the fixed income side, as inflation continues to come down, and granted it's coming down on a slower pace than expected, we should expect interest rates to come down. And if interest rates come down, bond prices will go up, and that's our view over the next 12 months or so.
And you mentioned the 90s there, so of course we think the tech bubble. Are we seeing then indications that we might see a repeat of that, or will this be different?
That's a great question, Rochelle. I'm not trying to create the fear factor that we're going into a bubble. I think what we're dealing with right now is a frenzy. I think some in the marketplace have also called it a mania. I think, when we came into this year off of a really difficult last year, and the Nasdaq and large tech companies obviously went down the most, they had an opportunity to rebound a little bit faster. But then when you started talking about innovation and where things could go with AI and that perspective, I think investors jumped on board because of these conflicting variables. They're a little confused where to allocate assets in this environment. I think moving forward, things will come back to the norm. This disparity that we've seen in growth stocks performance this year versus value stocks academically usually does not hold. And we believe that over time, as the economy slows, you'll start to see more of a bid for some of the cyclical areas of the market, like industrials, like infrastructure plays, but also small cap stocks have also been disproportionately traded down this year due to some of the concerns going on in the financial sector. So I think there are some opportunities, but over the next couple of months, expect volatility to stay elevated. And once we get through July earnings, I think that will be a test to say, do these earnings estimates make sense for the balance of the year and 2024? And if the answer is yes, then I think there'll be some optimism in the market, and we should expect markets to grind higher over the next 12 months or so.
Because it can be tough for investors who've had all this cash on the sidelines and have this fear of missing out. But so then we've seen some of these projections for where the S&P 500 could head, some in the 4,500 range. Where do you gauge it for the end of the year?
Well, as I was implying before, I think over the next couple of months, we're going to stay in this range because the market's going to test valuations to support the price that things are trading at. I think over the balance of the year into next year, if those earnings outlooks do hold for double-digit earnings to rebound in 2024, then I definitely expect the market to appreciate from levels that we're seeing from 4,000 and above. I think there's definitely some support levels that are in there right now below 4,000 in case those valuations are not justified by earnings. And as a result, I think any major pullback over the second half of this year probably would make sense to be an opportunity, Rochelle, as you said, for those investors sitting on the sidelines, probably to come back into the market.
Well, we'll certainly see if they heed that advice. A big thank you. Appreciate your insights, Brian Vendick there, MJP Wealth Advisors President. Thank you for your time.
Thank you.
All right, taking a look at Bitcoin trading to the downside after the Fed decision revealed a more hawkish outlook than expected. The crypto has lost some of its gains over the last month amid the turmoil in the trading platforms. Year to date, Bitcoin is up about 50%, recovering from last fall's crypto winter now. BlackRock, though, is close to filing an application for a Bitcoin ETF. That's according to a CoinDesk report. Now, BlackRock will be using Coinbase for the ETF and the crypto exchange's spot market data for pricing. It's worth noting that the SEC, which oversees ETFs in the US, has rejected every application for a spot Bitcoin ETF to date. All right, coming up, we'll dig into how the commercial real estate industry is faring after the Federal Reserve decided to pause interest rate hikes on Wednesday. Stay with us. With the rate of workers returning to offices remaining just below 50%, according to the Flex Index, and recent banking failures to boot, the state of commercial real estate remains quite volatile. But during the Federal Reserve's press conference on Wednesday, Chairman Jerome Powell had this to say when asked about the SVB banking failure and the risks to the industry.
There's a substantial amount of commercial real estate in the banking system. A large part of it is in smaller banks. It's well distributed. To the extent it's well distributed, then the system could take losses. We do expect that there'll be losses, but there'll be banks that have concentrations, and those banks will experience larger losses. So we're well aware of that. We're monitoring it carefully. It feels like something that will be around for some time, as opposed to something that will suddenly hit and work its way into systemic risk.
Well, let's bring in our panel for a discussion this morning. DWS Group Co-Global Head of Real Estate Todd Henderson, Marcus & Millichap CEO Hassam Naji, and Commercial Observer Finance Editor and Co-Deputy Editor Kathy Cunningham. A big welcome to all three of you here. So I first want to start with you, Todd. I want to get your reaction here from what we heard from Chair Powell, because there does tend to be this very broad brush when people think of CRE. They immediately think offices, but talk about some of the nuance within the sectors here and the sort of how you would characterize the state of play.
Sure. Well, thanks for having us today here, Rochelle. It's nice to be back on. Chairman Powell, I think what he said, there's definitely some truth to what he said. But as you say, the market has been painted with a very broad brush. The office market is not performing well, and there are some concerns there. But outside of the office market, we have really strong fundamentals. Frankly, some of the strongest fundamentals that we've experienced on record, particularly in the industrial space and the residential space. And if you look at our portfolio, just to put some numbers on it, just in the last quarter, we had 50% mark to market in rents for the new leases that we signed in the last quarter in our industrial portfolio. In our residential portfolio, we're 94% occupied today, which is the same occupancy that we had in the fourth quarter of last year and headed into a strong season. We're still seeing rental rate growth, NOI growth of 1 to 1.5% a quarter in our residential portfolio, which is really historically very strong. It's not the 5% that we saw per quarter in the 21 and 22 timeframe, but it's still very strong. So we have really a bifurcation, I think, in terms of performance of the office sector on one hand and the other sectors on the other hand.
And Kathy, I want to bring you in here for your commentary on that too, and where you're seeing some of the strongest and weakest performing sectors in CRE.
I think from our perspective, and obviously where we're pulling from our sources, data and information, what they're seeing day to day, I think the office sector is obviously the hardest hit, and particularly Class B office. That's where we're seeing the biggest pain points, and I think there's no surprise there. The headlines have always been full of negative headlines around Class B office, and a big part of that obviously is this looming maturity wall, this $1.5 trillion maturity wall that's coming our way over the next couple of years. And the reason behind the office sector is most worrying is because these assets really are going to have the hardest time to be refinanced today. On the other side of the coin, I think multifamily, industrial, we're seeing do very, very well, and they've actually performed very well for the past few years. And I'm sure Hassam has some data around that, but it's really been, there've been two sectors that we've seen consistently outperform the other asset classes within commercial real estate.
So Hassam, do you think this doom loop that we keep hearing about CRE then is overstated, or perhaps people really aren't understanding the nuances when you break down the different types of CRE?
I think the differences by property type has been well stated by my fellow panelists, and we concur with their observations. What is concerning at a macro level is the contagion from office to other property types in the way that it may affect credit availability and banks and other lenders. And we've already seen a major pullback by lenders in general, even though all the other property types outside of office are performing well. They have become so much more cautious, and the credit flows have become even more constrained than they were going into this year. That is affecting the whole industry. And when there is less credit available, there's less trading, and that has become problematic for a lot of our clients across all property types. They are pivoting. Those people that see the future in their favorite property type, favorite market, or favorite asset are finding ways to acquire those assets if they're priced right. And the good news is we're starting to see some price adjustments. We're starting to see some more reasonable expectations because of higher interest rates come back into the market. And when the alignment between buyer and seller is there with the right price adjustments, we're seeing transactions occur with less leverage, more equity, because again, people are believing in the long term. Even for office, there is opportunistic investments for office. I think the more important thing is the macro economy is doing well. Inflation is coming in. We don't believe the Fed is quite done yet. This was maybe a skip. So when we get the clarity of the tightening cycle really coming to an end, I think all of this will come together in a way that will start the next cycle. But in the meantime, there's just overall cautiousness by lenders in general.
And I mean, when we talk about office vacancy rates, one of the areas that keeps coming up is San Francisco. I do want to ask you about that. We obviously have Westfield making its exit there, as we're seeing a number of companies that have commercial space there also exiting. But Westfield was already sort of pulling out of the US market already. So Todd, what is your take on what's happening in San Francisco and whether or not that's likely to be replicated in other areas, any sort of other problematic regions that you're looking at?
There are some troubled markets outside of San Francisco for sure. And I think it's this broader trend of population migration patterns, which started prior to the COVID pandemic and accelerated through the pandemic. And we're seeing, significant movement to the Southwest, the South, and the Southeast. better business environments, more friendly business environments, cost of living, tax rates, et cetera, are driving this move of the population bases. I'm not calling the end of San Francisco. There's too much intellectual capital in the San Francisco area and market for there not to be a robust or a recovery of that market in time, but it is going to take time. There are other office markets that are challenged as well. The Denver office market is challenged. The Chicago office market is challenged. Parts of the New York City office markets are challenged. Every office market, frankly, has some challenging component to it if it is dominated by Class B or Class C office, more commodity office space. We are in a situation today where vacancies are approaching, if not higher than historically high vacancies that we saw when I began my career back in the S&L crisis and the RTC days. We believe those vacancies are going to go higher, and until the business cycle picks up and there are more office job growth, and frankly, we eliminate some of the excess supply in these B and C commodity office spaces, I don't think we'll see material recovery in the office market.
And so then, Hussam, I want to ask you, in terms of the opportunities you potentially see then when you have something like a San Francisco and some of these other metro areas under pressure here, do you see opportunities there, or could capital be better deployed in other aspects of CRE?
Well, we have a group of clients that have already taken advantage of distressed office sales and are interested in doing more because the long-term view is much better than the next, let's say, 2 to 4 years. We do believe there will be a shift back toward in-office, presence and team collaboration and people coming back in time. The next 2 to 4 years will be very rough, and it's true distressed pricing that's bringing in those types of opportunistic investors on the office side of the equation. On retail or multifamily, as been stated, we're not seeing nearly the level of distress, although in some of the urban markets like San Francisco, there's a ripple effect. As people didn't come back to work, that hurt retail, that hurt residential, and there's a contagion right there in an urban kind of an environment. The bigger shift isn't so much one market versus another, it's the urban versus suburban pattern that is affecting the market more than anything else. Urban America is going to take time to recover, and it's going to take public-private partnership to make it happen. And unfortunately, we're not seeing the start of that process. I agree that San Francisco should not be left for dead, but it's going to take initiatives to bring it back from the current state.
And Kathy, for people who are looking to invest in this space, potentially through REITs, how should they be approaching this market when you look at some of the different dynamics, especially as you mentioned there, the urban and suburban differences that are also putting pressure on the market?
I think if you're an investor in this climate, there's actually, if you have capital to deploy, like Hussam said, there are very good opportunities for you to deploy it in. A number of my sources are looking at the next couple of years as actually the best window for investment and also to be a lender. If you do have the capital, and a lot of my sources are saying, they're backed by global capital, which makes a big difference in an environment like this sometimes. But I think if you have the capital to deploy today, you can get very, very good deals in the market, whether that's real assets or whether that's you're investing in real estate debt, whether you're a lender that can be out there lending where others are not. And on the lending side, what we're hearing is the 24-25 loan vintage could be the best of a lot of lenders' careers because of the higher spreads, the lower loan to values. I think a lot of people are looking at the next 2 years as a chance to really upgrade their own portfolios by capitalizing on some of the distress that's in the market just now and adding to their portfolio in a way that they couldn't do 2 years ago. So I think if you are an investor who has the capital to deploy today, as long as you're careful and prudent and savvy by the way you do it, there's a really good chance here for you to invest.
So certainly some opportunities to be had. And thank you for breaking down all the nuance and context that's happening in CRE. A big thank you to DWS Group Co-Global Head of Real Estate, Todd Henderson, Marcus Miller, CHAP CEO Hussam Naji, and Commercial Observer Finance Editor and Co-Deputy Editor Kathy Cunningham. Thank you all for joining me this morning.
Thanks for having us.
Thank you.
All right. You're so welcome. All right. Coming up, AMD goes head-to-head with NVIDIA. But are we discounting other players in this space? We talk AI wars next. Let's do a quick check on the new indicated open for Carver as we await that IPO, now expected to open at $38 to $40 a share after originally being priced at $22 a share. A big jump there. All right, well, AMD is going head-to-head with NVIDIA. Earlier this week, the semiconductor company unveiled its most advanced GPU for AI yet. And now that AMD is pushing it to be a key player in the coming AI wave, investors are curious to see which other chip makers are best positioned to challenge NVIDIA's dominance. Let's bring in Daniel Morgan, Synovus Trust Senior Portfolio Manager, to discuss here. So just how much tougher does this now make the competition for NVIDIA? Good to see you.
Well, we have to bear in mind, Rochelle, that NVIDIA was kind of first to the market in AI. They were one of the first chip companies to really embrace it before AI became the big hot word. They have 80% market share. NVIDIA had about a 40% market share back in 2019. So you can see their market share has really doubled. And now you have a slew of companies. Obviously, on Tuesday, we had AMD, as you were mentioning, came out with their AI blueprint. They've got a couple of new things they're working on. We heard about the deal with Microsoft, codename Athena. They also have the Instinct MI300, which is another chip that they're promoting directly against NVIDIA. They also have an architecture called Alveo that they're also promoting in that space. So they're trying to ramp up. But we have to bear in mind, Rochelle, that AMD only has about a 3% market share in the server data center space. So they have a lot of work to do.
Well, certainly they at least tried to make a start, have a big splash here. What do you see as the potential headwinds in this space for AMD?
Well, it's just that NVIDIA was first to the market. So you have everybody using their chips, and now you come along later, kind of like really Intel was a dominant player in the CPU market, and AMD was always trying to gain market share against them. So they're not unaccustomed to being the underdogs. But the biggest challenge is just kind of breaking and showing that their chips are superior, that they can run faster, they're more efficient than what people are already using in terms of NVIDIA. So it's always hard to be the second guy coming in, right, when the number one player has 80% of the market.
And especially as you're seeing sort of other companies trying to in-house chips and get more advanced there, which does bring in another question, which is, of course, China, where a lot of these chips, in fact, the majority of these chips are going to be sourced from. How does, when you have sort of AMD in this space and NVIDIA in this space, but really China and Taiwan Semiconductor at the center of all this, how does that dynamic impact how investors should be approaching this?
Well, you're right, Rochelle. I mean, there was an announcement that came out previously that China has banned some of the Hopper 100 NVIDIA chips. Now, that's a huge chip for them. There are certain components that I guess they feel are a security risk. That's a risk in terms of China pushing back. We know about a month ago, they came out with a ban on some of Micron Technology's DRAM that is used in certain products. So that also, as you mentioned, the risk of Taiwan Semiconductor, Samsung, Global Foundries. Taiwan Semiconductor produces pretty much all of NVIDIA's chips. They're in a part of the world that could be very hostile in terms of China. Is there going to be increased magnification in terms of problems over there that could hurt their ability to produce those chips? So right now you have not only China pushing back on different chips that are coming out of the US that are being produced by TSM, but you also have the risk that there could be some sort of elevation in a battle between Taiwan and China that could impact TSM's ability to produce chips. So there is some risk in that, no doubt.
So then, obviously, you have AMD and NVIDIA in this space in a very sort of still early stages here, but we're really seeing some astronomical projections here as we're seeing the rest of, tech sort of jumping into this. We're seeing AI sort of dotted into everybody's earnings call. But what's your take on some of these projections that you're seeing about where sort of the generative AI and large language model projections are going to go from here?
Well, Rochelle, we're already starting to see a positive impact. Up to the NVIDIA report a month ago, which you and I talked about, there really wasn't a lot of evidence that AI was actually impacting any of these chip companies in a real big positive way. We know that NVIDIA came out, they raised their target for the next quarter. I think it was $11 billion in total revenues, a huge increase from what the street was looking for. So we finally saw some evidence. But as we kind of go through and look at these other companies, we are starting to see some evidence. Marvell Technologies has projected that their chip called PAM4 DSP chip will do about $400 million in revenues next year. So that's a positive. We have other companies coming out and communicating that they're actually seeing a positive impact from some of the AI chips that they're bringing out. But we have to remember, Rochelle, what's happening is we have a secular slowdown in terms of data center CapEx spending. We saw that in the numbers with Azure, AWS, and GCP. So to counter that, you have AI spending increasing. The key is for these chip makers, can it be enough to offset the secular downtrend that we're seeing right now, this little blip on the screen in data center? And NVIDIA is the only one so far that's really been able to show that.
Certainly will be a delicate balancing act they'll have to do there. Always great to have you on. Daniel Morgan, Synovus Trust
Rochelle.
Senior Portfolio Manager. Thank you for joining me this morning. Right, well, a number of health insurance stocks took a hit yesterday after United Healthcare said they were seeing an increase in hip and knee replacement surgeries. But today, it's a different story. Medical health insurers are now rallying. Yahoo Finance's Anjali Kemlani has the details for us. Hi, Anj. Why the turnaround here?
Hey, yeah, well, to start off, let's just take a step back and get a sense of where this came from. It came from a United Healthcare executive at a Goldman Sachs conference saying, quote, that they're starting to see seniors getting more comfortable with accessing services for things like knees and hips and the like, and that really puts pressure on Medicare spend. So that's what really set off that hit in the stocks. If you take a look at what that really means, it's what is known as medical loss ratio for insurers, and that is required by the Affordable Care Act, where insurers are basically supposed to spend a good portion of the premium dollars that they get in. That number is 80 to 85%. That's what they target. So if it's not met, then they end up having to rebate those dollars back to the clients, which typically happens actually more in the individual market rather than large group or even, Medicare and the like. So what really we're looking at is the Medicare side of it. And of course, we know those players are some of the largest in the country, including the likes of United, Cigna, Humana, Centene, and the like. All of those are really where the pressure was building up. Now, what they really have to look at is United Health's projections. They did say in the last quarter they were looking at 82 to 83% of that MLR number, and that still holds. It was just up slightly based on this uptick in surgeries, and that is coming from the pent-up demand that we saw because of COVID, of course. That really put a damper on any kind of inpatient or outpatient surgery, and that's what we're starting to see, just a little bit of an uptick. Now, this can possibly impact these companies moving forward in the upcoming quarter on whether or not they priced correctly their prices and their bids for the spend for 2024. So that's where it becomes kind of an issue that they need to look at on whether or not they accounted correctly for the potential uptick, or if this is just sort of a smaller blip that they're just starting to see a little bit right now. So that could affect their revenue moving forward, and that's where some of the confusion came from. Some analysts said it would be an overreaction or not necessarily accurate to look at all the companies broadly as a result of this, but we'll have to just see when their next round of earnings comes up to see exactly what happened with these numbers.
So then, Ange, for consumers who are wondering, look, should I be worried about, my costs going up, or how soon I might start seeing this showing up? What should they take away from this?
Well, generally, there actually is, a look at numbers for the upcoming year. There is potential for increased premiums, but this, like I mentioned, largely affects the Medicare business. That's where they're looking at potential for the increased rates and increased spend. There are other numbers that just came out yesterday looking at the estimated spend for the larger commercial market, and there might be a slight increase in premiums, again, because we're now seeing more utilization of the healthcare system. Broadly speaking, people are getting back into the routine of seeing the doctor, scheduling surgeries and other procedures. And so we can expect that that's going to increase the spend for the companies, for the insurance companies, and therefore translate into a slight increase in premiums. So that's just what the projections are for now. And of course, when the rates come in, we'll know more for sure.
All right. Well, thank you for getting us up to speed on that. Anjali Kemlani there for us. Thank you. All right, coming up, we'll be taking a look at Amazon's new second headquarters in Arlington, Virginia, with Yahoo Finance's Ali Garfinkel. Stay with us. Amazon's second headquarters is finally open for business as of today. The new 22-story towers located in Arlington, Virginia will house 8,000 employees. Here to give us more details is Yahoo Finance's Ali Garfinkel. Hey, Ali.
Hi, Rochelle. Make no mistake about it. This moment is a big day for Amazon, and it has been years in the making, the better part of a decade, really. The reality is this is a huge facility. We're talking 2 million square feet of office space, 50,000 square feet of retail space. And in a lot of ways, it sounds like Amazon's headquarters in Seattle. You have bike paths, dog parks, gardens. But it hasn't been easy to get here. The project has been repeatedly delayed, and even as recently, we saw some delays in March in construction. Rewinding 6 years ago, Rochelle, it's hard to overstate how big of a deal Amazon's HQ2 was. HQ2 was first pitched to cities as this economic development prize for the ages, really. Think about it, more than 200 cities at the time were bidding for the chance to host HQ2, and of course, the winner was Arlington, Virginia. But that was a pre-pandemic time, right? But that was before, of course, remote work was widespread, for example. And now we're sort of in this odd space. HQ2 is opening. It's a good day for Amazon, but the bill is coming due in a very different environment than Amazon could have imagined. Ultimately, I think the question a lot of people are going to be asking here is, will Amazon be able to leverage this new headquarters in a very different environment, or will it be a sunk cost? Can Amazon make good on its promises? The clock is going to start ticking today, Rochelle.
I mean, it's true. As you mentioned, a lot has changed in the past 6 years. I mean, now a lot of companies are in this sort of cost-cutting phase of the business. What are the expectations here for what having this second headquarters is going to bring to the table for Amazon?
I think it's unclear at the moment because before the pandemic, there was a lot of, oh yes, this will create more jobs. It will create more workers who are these high-end office workers who can change Crystal City, change Arlington, Virginia, really bring in a lot of tax revenue as well. And now it's the sort of thing where Amazon has been in the midst of job cuts, tens of thousands of job cuts, in fact, over the last year. So I think the expectations are a lot less clear than they would have been. And it's going to be up to Amazon over the next couple months to really set the agenda for what it means for them to have a headquarters on the East Coast.
I'll be looking forward to having a visit there. It's interesting because when you see that headquarters and you look at the rest of sort of the Crystal City area of Arlington, it's very concrete. It's very sort of old school DC. So it's interesting to see that this gargantuan building that Amazon has here.
It's kind of
see how that all plays out.
It's a move, definitely.
It is. It's got like Tron vibes, but I'm here for it. A big thank you to our very own Ali Garfinkel. Thank you as always. Right, shifting gears. Uninsured deposits in U.S. banks fell $597 billion in the first quarter, which is a 7.8% sequential decline and a 15.2% drop year over year. Now, bank deposits became a major focus for the markets back in March when Silicon Valley Bank and Signature Bank saw massive bank runs. Both banks had some of the largest number of uninsured deposits, 93.8% and 89.3% respectively. Only 3 other banks have estimated rates above 80% for uninsured domestic deposits. That's Bank of New York Mellon, Northern Trust Company, and State Street Bank and Trust Company. Now, the fall in uninsured deposits can be seen in both dollar amounts as well as the percentage of total deposits, dropping to 42.2% from a high of 47% in the first quarter of 2022. All right, coming up, we're taking a look at Carver. We'll be going to the New York Stock Exchange to speak with Carver's CEO, Brett Schulman, on the day of their IPO debut. Taking a look at Kava shares now, currently trading at about $43 as it started its IPO today, open trading at $42. That's 91% above its IPO price. That's after making its public debut this morning, after, as we mentioned, they're originally pricing at $22 a share. Let's get to Yahoo Finance's Brooke De Palma on the floor of the New York Stock Exchange for more on this. Hey, Brooke.
Good morning, Rochelle. I'm here with Brett Shulman, Kava co-founder and CEO. I mean, such an exciting day for you. Congratulations on the IPO. First, break down what this day means for you personally, and has it surpassed your expectations so far?
Yeah, thanks, Brooke. Thanks for having me. It's been an amazing day. It's an incredible validation of all the hard work our team has put into the business the last 12 years to help get us to this point, and that this is the kind of next beginning of the next chapter in our journey.
And right now we're trading at $43 a share. Are you concerned that the valuation here is a bit too high and that expectations are now way too high for the company?
Well, I told the team last night, we're not going to focus on the daily stock price. Markets go up, markets go down. We're focused on the same thing we've been since we started, which is our long-term vision of defining the Mediterranean category and bringing the Mediterranean way to communities across the country.
Yeah, let's talk about the way that you started. Back in 2011, you opened up that first fast casual concept. I think one of your co-founders called it a chef casual concept. What was one of the biggest challenges that you faced to get to this point you are right now?
Yeah, I like to say scaling restaurants is hard. It's not like scaling SaaS software. Right. It takes a lot of great people and great talent. And so really developing our restaurant team leaders and building our team out to scale this business, we focused on our culture and our mission to bring heart, health, and humanity to food. And when we do that, we get great people on board that deliver that great food and great hospitality and help us get to where we are today.
Now, Brett, I read through your S1. When do you think that Kava will turn profitable?
So we're focused on our long-term growth. We've got a tremendous unit economic profit engine. We saw in Q1 alone, we generated $50 million at the restaurant level. That's compared to $91 million all of last year. So very healthy margins at the restaurant level, and that's kind of the lifeblood, the oxygen of our business. And we've invested in significant infrastructure over the years, whether that's our manufacturing infrastructure, our digital infrastructure, or all the new restaurants we've opened over the last few years. And all of that is now flowing into the business and really creating great tailwinds on that path.
Yeah, let's talk about that growth plan. Right now, you're at 263. Plan to open or have 1,000 locations in less than a decade. How do you get there?
So we get there with the great team I talked about, the infrastructure I talked about. We operate in 22 states in the District of Columbia today. That means there's 26 states in the continental U.S. we're not operating in today. So there's tremendous growth opportunity within our existing footprint and all those new markets we're not in, like Chicago, where we're going to open next year and start our entry into the Midwest.
Now, speaking of Chicago, one of your competitors, Sweetgreen, just opened up an automation inside. They're using robots. We've also heard from Wendy's, from McDonald's using voice ordering technology. Can we expect Kava to have AI and automation in future restaurant design?
Well, we think there's a lot of opportunity within AI specifically when you think about predictive labor scheduling, predictive ordering, prep, that can really do the trick of making it easier for our team members to run a great Kava and deliver that great food and that great hospitality. That's when things are working well for us.
And you're investing heavily in digital. I believe more than 50% growth in digital sales last year. How does that customer change in terms of how much they're purchasing and just how much potential there is in the digital consumer?
Yeah, we do see a 27% higher check average in the digital channel, but what we try to do is create basically a multi-channel platform where you can choose the channel you want to engage with us on. Because if it's an urban consumer or a suburban consumer, a young single or a family, that need state may be very different. So we want to basically put the control in your hands to say, I want to engage and I want to digital order and pick up off the shelf at Kava, or I want to come in with my family and sit down in the dining room and eat a meal, or I want to come in my car and pick up my order out of one of our drive-through pickup lanes, which we now have 20 of and growing.
Right. And in addition to that, right now, inflation is the name of the game, especially when it comes to not just Kava and your food products, but also when it comes to American consumers choosing where they're going to go. What sort of customer do you attract, and how do you get maybe that McDonald's customer that's looking for value to try out Kava?
Well, there's two things, Brooke. There's the fact that our food has an incredibly broad appeal and diverse appeal. When you look at our gender mix, 55% female, 45% male, great generational mix, and great income mix. You know, we're able to compete down income brackets because of our value proposition. And one thing we did to lean into that value proposition, I talked about that infrastructure we've invested in over the years. That now allows us to really leverage into in the business and not have to raise price as much as maybe some of our peers have. So last year, less than 5% in restaurant pricing, even as we expanded restaurant level margins. So really trying to put our best foot forward to our guests and make sure we can invite everyone to our table.
And can customers expect another price increase to happen later on this year or perhaps next year?
We have no planned price increases for the remainder of the year.
And in addition to that, I mean, we're also seeing sort of companies go in terms of drive-through concepts, engage with customers in a different way. When you think about your future store footprint, and you think about the size of that, of course, that's a bigger footprint. Does it come at a higher cost? And are you worried about that?
Yeah, we have seen some developmental inflationary costs the last few years, but that's embedded in our model. We have a core format that we create derivations of, again, to meet the needs of the guests in that specific trade area, whether it's one of our drive-through lanes, whether it's a unit here in Manhattan that has no seats in the dining room and multiple digital order make lines, or a restaurant in the suburb that has 80 seats in the restaurant.
Right, and lastly, CPG is something that you guys started with. You had your dips and your spreads available at 650 locations, including Whole Foods. How big is that business today, and do you plan to scale it after this IPO?
Yeah, it's a very small piece of the business today. A lot of our manufacturing capacity goes to support the growth of our restaurants, but there is that option in the future that if we think that there's opportunity there to lean into it, and we have the bandwidth as an organization, we have a lot of restaurants to open, that's there for us to go after in the long term.
And Brett, I have to ask, is roasted red pepper hummus and crazy feta still your go-to sides?
You got to get a scoop of crazy feta no matter what bowl you order at Cava.
Wonderful, wonderful. The crazy feta is my favorite too. Brett Schulman-Cava, co-founder and CEO. Thank you so much. Back to you, Rochelle.
Thanks, Brooke.
All right, a big thank you to our very own Brooke De Palma there, who was joined there by Cava CEO Brett Schulman on the floor of the New York Stock Exchange. Thank you to you both. All right, let's give you a final check of the markets as we head into the noon hour. We see here still positive gains here across the board for major indices. That buying action picking up. Look at the Dow now, up more than 350 points at the moment, or up more than 1%. The S&P 500 there also charging ahead, up about 0.8%. Tech-heavy Nasdaq there, seeing some gains, but not compared to as high as compared to the Dow and the S&P though, but still up about 0.6% or 86 points on the day. All right, well, that does it for now. I'm Rochelle Akufo, but I'll be back with you at 11 a.m. Eastern, and Yahoo Finance will be back at 3 p.m. Eastern. We'll see you then.